Hello everyone, welcome to this investment banking full course by Intellipaat. Did you know that companies such as JP Morgan Chase, Goldman Sachs and Morgan Stanley pay an average salary of 20 lakh rupees in India? Whereas in the USA, the average compensation they pay lies around 1,50,000 US dollars. Not only that, the money that the top 5 investment banks hold is almost 30% more than the GDP of United States of America. What that means is that the investment banking industry is highly profitable and one of the best career options out there. But it is not overpopulated with job applicants. The reason why I am able to confidently say that is right now on just the Naukri job board, there are more than 13,000 plus investment banking related jobs available. If you consider numerous job boards that are out there, this number could even be more substantial. And if I were to talk about salaries, you will be amazed. Glassdoor reports that in India, you can expect a salary between 12 lakh rupees to 85 lakh rupees. Whereas in the United States, you can earn between $140,000 to $350,000. Top investment banking organizations are always on the lookout for skilled investment bankers. So if you have a keen interest in tracking how the financial world looks, it's time you start learning the skills of investment banking. And to help you with that, we bring you a free investment banking and capital market course. This investment banking program has been taught by top industry experts from companies like JP Morgan Chase, Bank of America, Goldman Sachs, etc. and aims at making you job ready. But before we get started with the course, make sure to hit the subscribe button and click on the bell icon for Intellipaat YouTube channel to never miss out any updates from our end. Now let me take you guys through the agenda for this session. First, we will begin by understanding what is investment banking. Next, we will move to introduction to investment banking. Following this, we will dive into the money market. Moving further, we will explore the financial markets and cover topics like debt markets and interest rate, the stock market and the foreign exchange market. Alongside, we will discuss the function of financial markets. We will also highlight the structure and classification of financial markets and touch upon internationalization of financial market, including a global perspective on the relative decline of US capital market. Then we will shift focus to the function of financial intermediaries, covering their roles, type of financial intermediaries, and challenges like conflict and interest. In the next section, we will cover the banking overview, starting with the bank balance sheet, followed by basics of banking and the general principle of bank management. After that, we will tackle the interest rate and will also introduce to present values, its application in loans and bond, and real-world example to simplify these concepts. Finally, we will discuss business organization and conclude with an overview of rates of return and their importance in assessing investment. I hope you guys are clear with the agenda. Let's take the very first topic from our list.
Now, what is investment banking? It is a specific branch of banking that helps businesses raise funds and provides them with financial advice and support. It provides a substantial financial advising, capital raising, government and financial institution services, financial and risk management services, and help to enterprises. An investment bank is a type of financial services firm that serves as a middleman in large and sophisticated financial transactions. When a new firm is ready to launch its initial public offering, or also known as IPO, or when a company combines with a rival, an investment bank is approached. For large institutional clients like pension funds, it also serves as a broker or financial advisor. Now let us move on to what does investment banks do. Let's begin with a simple example of a company named ABC. Suppose ABC wants to merge with another company. How will it know that the other company will be beneficial for it? Or how is it going to raise the desired funds? And who is going to handle the complete documentation and help in figuring out new investment plans? Well, the short answer to all these questions is an investment bank. Investment banks play a vital role in making a company go big by acting as a risk taker or say middleman. Typically, investment banking focuses on two main areas. The first one is the M&A advisory, and next we have underwriting. So M&A advisory stands for Mergers and Acquisitions Advisory. It is the process of assisting corporations and institutions in locating, evaluating, and completing company acquisitions. Underwriting is a procedure used by banks to get funds from investors for a client, mostly in the form of equity or debt securities. Now let us move on to the next topic, which is how do investment banks work? Investment banks are divided into two types, the sell side and the buy side. Now, the sell side shares of newly issued IPOs, provides market making services, places new bond issues, and assists customers with transactions. Coming to the buy side on the other hand trades securities such as shares and bonds in order to maximize profits. It collaborates with hedge funds, mutual funds, and pension funds. Now, let us take a look at the careers available in investment banking. Investment banking jobs are among the most desirable jobs in the financial industry. As an investment banker, you will be expected to assist the clients in raising funds and expanding their businesses. Though it is not that easy to get into the domain, once you make it through the journey, the results are really rewarding. The average salary ranges around $100,000. With years of experience, you can even earn up to $500,000 per annum. The main role that investment banking demands is to provide assistance to firms, governments, and wealthy individuals in expanding their businesses by acting as a medium that will handle the complete procedure of analyzing and evaluating the business and will also manage all the documentation work involved in the process. The world of investment banking is not for everyone to live in. This job profile comes with a very high competition and extremely tight working hours. But the financial perks offered are unparalleled. You will live a very fast-paced life and deal with exquisite clients while enjoying a lifestyle that others can only dream of.
Just a quick info guys, Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
Let's first turn the clock and understand how this banking field got incarnated. From the early 19th century, commercial banks in the US performed the functions that we now associate with investment banks. But during the period of Civil War, everything just suddenly changed. The US federal government needed more money to finance their military initiatives. However, they had no bright idea about how to raise that substantially large amount of money. That's about the time the man named J. Cook, the Philadelphian financier, stepped up. In 1861, this guy laid the foundation for the first ever American investment bank aiming to help the federal government. That means the US government became the first ever client of investment banking. Governments wanted money to fund their multiple projects. But why would someone invest their hard-earned money without any sort of security, right? That's where the idea of releasing securities, or what we commonly call bonds, came into existence. Governments started issuing the bonds to gather investments, build infrastructure, and more importantly, to support its growing economy. Initially, what investment banks did is they bought all those bonds from the government and sold them to the private investors for profit. Today, they function in pretty much same way itself, just with different sets of parties involved. Now, this might lead towards another question. From where those billions of dollars are pouring into the business? Well, the business model is quite straightforward. Investment banks purchase the assets that hold monetary values, otherwise known as securities, and sell them to the private investors for a certain amount of fee. This whole process is termed as underwriting. Now, why would these third parties want to take the help of a middleman like investment banks and spend money doing so? Why won't they deal all by themselves? The perks of making this kind of deal is that the middleman is responsible for the risk of distributing all the securities. If they are unable to locate new investors, they'll be forced to keep those securities. To intuitively put this forward, investment bankers are the risk takers who take all the risk for secure transactions between investors and clients. But risks are not only entitled to the investment banks. commercial banks also take risk. However, there is huge degree of difference between those risks. The commercial banks deal with the common individual and small to mid-sized companies, giving out smaller sums of money like personal loans, business loans, vehicle loans, home loans, etc. These financial firms benefit from the interest they charge on the lump sum of lent money. Whereas investment banks deal with huge companies and high risk startups, acting as a bridge between corporations and investors. In the process, they can earn huge amounts in fees as there is adage. Higher the risk, larger the profits. I hope that you guys have a clear picture of investment banking in your head. Moving forward, we'll understand how these investment banks function. Well, by now we made it clear that investment banks act as a bridge between the investors and the project owners who require money. Well, the other way to put this around is investment banks are the bridge between demand and offer. They are bridging the people who have capital and are eager to invest and the people who need financing for their own projects. In the initial days, government entities were the main clients of these investment banks. Governments took support from these banking institutions to build highways, railroads, to improve infrastructure, to fund military operation and whatnot. Now, what these governments used to do is they used to issue some bonds and approach investment bankers or middlemen to produce some sort of financial solution. The reason behind approaching these so called middlemen was pretty simple. The government did not know how to price their bonds, how to sell them in the market. They were not at all unbiased in the negotiation of proper terms, and individual investors did not think that their investments will be protected without having the higher bargaining power. These facts tell you how important our middleman or investment banker was. Now, from this point on, the investment bankers used to take on the business. Their main task was to negotiate great deals with government to sell a fraction of their bonds to their investors. And before even doing that, they used to visit the investors and create a list of those who were ready to purchase the bonds the government had. Just to be clear, that they could resell all the bonds issued and would not be stuck with any of those. Now, all this sounds quite easy, but wait, there is more to this. Actually, there are two types of scenarios both the investors and investment bankers can face. The government can default and stop repaying its debt, or it could try to renegotiate the terms. I mean, both of these scenarios are not good for investors, hence, use the middleman. Now, let me give you an example where this scenario happened for real. In 1842, 8 American states defaulted because their economies relied heavily on the production of cotton, and the price that year was too low. These states could not repay their loans and refused to pay it. Now, this puts the capital of investors at substantial risk. The middleman who arranged this sale reacted in a decisive manner. All the attempts of these states to raise a new capital were unsuccessful. James Rothschild was the name of this famous middleman. This famous investment banker was quoted saying to a federal state representative that you may tell your government that you have seen the man who is at the head of financier of Europe and that he has told you that they cannot borrow a dollar, not a single dollar. As a result of these Rothschild's actions, the defaulted states agreed to a restructuring plan, which satisfied the investors and repaid them their capital. This scenario proves how important it is to have a reputed investment banker in deals like this. Now, this is a scenario of past. What about now? Well, the thing is, investment banks still do work the same. It's just they offer a variety of services now. They definitely still do raise capital, but besides that, they have specialized in areas like mergers and acquisitions, underwriting, private equity, and venture capital. These banks hire quite a number of employees every year in roles such as banking analyst, investment banking associates, portfolio managers, private wealth managers, market research analysts, investment strategists, investment consultants, and many more. And using these sets of people, they run the empire of money. Different teams work on different sets of deals in the particular demographic areas. And the presence of these top investment banks is of global level. They have rooting in almost every industry and every country possible. Also, these financial institutions have been around for centuries now. Hence, people do put immense amount of trust in their names. Now, just to give you an idea, here is the list of notorious investment banks across the globe. We have Barclays, JP Morgan, Citi, Credit Suisse, Goldman Sachs, Deutsche Bank, Merrill Lynch, and Morgan Stanley. Now, the youngest of these banks is 88 years old. And if we talk about their average age, it is significantly higher, that is 187 years. I hope these statistics help you contemplate the huge market experience these financial institutions bring to the table and how big of a deal they are. Now, moving forward, let's look into the career prospects that you can look out for in the field of investment banking. It is crucial that you understand the world will always need companies that could drive innovation. Those innovative companies will always require huge investments, and also the people with money will always look out for opportunities to invest and savor their future, which clearly depicts the need for our middleman, that is, investment banking in this world. And hence, you should believe that investment banking is here to stay and it will. More increasingly, if you are looking to build a career around this field, then as a beginner, you could be entitled to the salary of 113,000 US dollars in the United States of America, whereas in India, you can expect the average salary of 12 lakh rupees, which could also go up to 70 lakh Indian rupees. And the best way to climb the ladder of success and gather lucrative offers is to learn the intricacies of investment banking operations.
Just a quick info guys, Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by I am Ranji. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed I am Ranji faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
In the vast monarchy of finance, the term money market often emerges shrouded in mystery and ambiguity. What exactly is the money market and why is it a vital cog in the wheel of global economy? Have you ever wondered how the rich and the savvy make their money work for them? How do they navigate the intricate web of investments to maximize their returns? Well, the answer lies around the financial market known as the money market. Today, through this video, we'll delve into the world of money market, what it is and how you can use it to grow your own money. But before we do that, I'd like to request you guys to enable both the subscribe button and bell icon for Intellipaat YouTube channel so that you won't miss out on multiple updates coming from our end. In simple terms, money market refers to trading in very short-term debt investments. At the wholesale level, it involves large volume trades between institutions and traders. You can visualize the money market as a bustling marketplace, alive with the vibrant energy of investors, banks, corporations, and governments. Here, the money market acts as a magnet, attracting those seeking safety, liquidity, and a steady return on their funds. It's a place where financial giants gather, looking to park their wealth in instruments that provide stability and preserve capital. But what makes the money market truly alluring is its ability to influence the broader financial landscape. Like a hidden conductor, it coordinates interest rates, shaping the cost of borrowing for everyone from homeowners to multinational corporations. It influences currency exchange rates, impacting international trade and global economic stability. It even plays a role in the intricate web of central bank operations, helping to regulate the flow of money within an economy. Now let me tell you how you can leverage this market to grow your own money. Let's say this person over here is Alex. He's quite a wealthy individual and he's looking to explore the money market to potentially earn some good returns. So how can Alex dive into the world of finance and grow his funds? Well, there are few options. First one is to invest in short-term instruments such as treasury bills or commercial paper. Treasury bills are essentially short-term loans issued by the government, while commercial paper represents short-term debts issued by corporations. These instruments are considered relatively safe investment with low risk. To invest in treasury bills, Alex can participate in government auctions where these bills are sold. Alex would submit bids indicating the amount he wishes to invest and at what interest rate. If successful, he would receive the treasury bills which mature in few months, and upon maturity, he can redeem them for the full face value, earning a profit from the interest rate difference. Alternatively, Alex could invest in commercial paper through financial institutions. By purchasing these papers from corporations, Alex essentially lends money to them for a short duration, typically ranging from a few days to few months. In return, Alex earns interest on his investment when the commercial paper matures. Second safe option for Alex is to explore money market mutual funds. These funds pool money from multiple investors, including individuals and institutions, to invest in a diversified portfolio of money market instruments. Alex can invest his funds in such mutual funds where professional fund managers handle the investments and seek to generate returns while managing risk. By investing in these short-term instruments or money market mutual funds, Alex can potentially earn decent returns while keeping his funds relatively safe. It's important to note that the returns may not be as high as riskier investments, but the primary objective here is to preserve capital and ensure liquidity. So guys, those were the risk-free investments money market offers. Of course, there are riskier investments too that allow mammoth returns, but with promise of high returns comes the great risk. I hope now you understand what money market is.
Just a quick info guys, Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
So without further ado, let's start. The basic question that we first try to understand this module is, why do we want to study financial markets? Okay, so if I just pose this question to you, that why should you care about financial markets? Okay, so as you can see, the answer is right now in front of you. Okay, so financial markets are very crucial in our economy for two particular reasons. Number one, it helps in channeling funds from savers to investors, and therefore by channeling these idle funds from savers who do not have any productive use for these funds to needy investors who need those funds for productive purposes. Let's say there is an investor who wants to build a factory. Okay, he doesn't have idle money with him, but there are n number of savers, like n number of households. Savers can be individuals, it can be households, etc., etc. So we have, let's say, small savings. Some of us maybe have maybe 5,000 parked in some savings bank account at, let's say, State Bank of India. Some may be having 10,000 at, let's say, ICICI Bank, etc., etc. So as an individual, we may have small savings, personal savings parked at banks. Let's say some may even some of us may also have, let's say, savings accounts with, let's say, post offices, etc., etc. So we don't know what to do with that fund, and therefore we have kept with the bank or post office or other depository institutions so that we get an interest on those idle savings. But there is another group of people, another set of people called investors who need those money, but they don't have that money, but they know what to do with that money. Okay, for example, let's say Geo is expanding and Geo needs money. So Geo is doing business, Reliance is doing business, and it knows what to do with your money. But let's say for some reason, it doesn't have that huge corpus with it right now. Okay, So therefore, financial markets comes in the picture at this point of time, and it therefore kind of acts as a bridge between savers and investors. And therefore, by actually routing this idle fund, which had otherwise no productive use or which was actually not being utilized to its full potential, to investors who know best what to do with that fund, we are promoting economic efficiency. Okay. Similarly, the second reason why we need to study financial markets is financial market activity. Anything that goes on in the markets is bound to have repercussions at three levels. Okay. First is it's going to affect your personal wealth. Okay. For example, I have invested 1,000 rupees in mutual fund. Market goes up, so I'm the, let's say in next 3 months market goes up by 5%, and let's say my mutual fund also goes up by 5%. So therefore, I have become richer. Okay, so it has affected my personal wealth. Likewise, market activity can also affect business firms. It is also going to affect economy as a whole. Okay, so generally, what has been found is that you can just look around the economies around the world. You will find that one peculiarity you will find that if you just see, if you study the financial economy of a highly developed country, let's say Germany, US, UK, okay, so you'll find that in these well-developed economies, financial markets and financial institutions are also highly functional. They are well-developed. They are functioning very, very properly. Okay. On the contrary, if you just visit one of the undeveloped countries, let's say one of the African countries, let's say Sudan or something, there are so many undeveloped countries, Kenya. Okay, you will find that those countries, they're not well developed. And likewise, coincidentally, you will also find that the financial markets in those countries, in those economies, are not functioning very efficiently. In some cases, they may be dysfunctional as well. Some of the financial markets may be incomplete, some may be lacking, etc., etc. Okay. A well-functioning financial market therefore becomes a very, very critical factor in producing high economic growth. Okay. So, because you can see that they are kind of correlated. Okay. So we are going to study each of these aspects. We are going to see some of those statistics and how we are going to examine. We'll look all of this for this module. Now, what I'm going to do is step by step, I'm going to take one step forward. Right now, what I have done so far is I have given you a motivation. Why do we need to study financial markets? Now, in the next step, I'm taking one step forward and I'm trying to show you what are the different segments of the financial markets. Okay, so financial markets is a very big term. Okay, of course, there are structures. Financial market is very structured. So there can be so many ways in which you can classify and understand financial markets. So here, what I'm trying to do is I'm going to classify financial markets very, very broadly. And let's say I'm saying that there are few segments in financial markets. For example, first segment could be debt market. Other segment could be stock market or also known as equity market. Third segment could be, let's say, a foreign exchange market. Okay. Likewise, there can be many more segments. But right now, we are going to understand segments one by one. So we are here in debt market. So first, let us consider debt markets. And primarily, what we'll focus in this debt market is how activities in the debt market, they're going to affect the well-being of businesses as well as consumers, because previously in the previous slide I had made it clear that market activity, anything that happens in the market, is going to affect the fortunes of individuals, the fortune of business, the fortune of the economy as a whole, the well-being of the economy as a whole. Okay, so again, coming back to this debt market, we are also interested in understanding how activities in the debt market is going to affect the well-being of businesses as well as consumers. So, for example, let's say when interest rates rise, this is one activity which happens in the debt market. Let's say interest rate goes up. Okay, so we need to understand at a very, very broad level, at a very, very naive level, let's say that how, when interest rate rises, how is it going to affect the economic behavior of businesses and how the behavior of consumers change. Okay, this is our motto in this So anyway, what do you expect when interest rates go up? Okay. First thing I would say is, yeah, we expect that businesses would cut down investment spending, because what has happened because of going interest rate hike is cost of financing is capital expenditure. It has become more expensive. It has gone up. Okay. Similarly, at a more personal level, so let's say an individual was planning to purchase a new house. Individual was planning to buy a new car. Okay. Now, because interest rates have gone up, what would happen is the cost of financing that purchase would be higher now. Okay. Again, let us now understand few basic fundamentals about debt markets. So first, let us understand what is a security or a financial instrument, because we are going to encounter this term security or financial instrument repeatedly throughout this module. Okay. So what is a security? Security in the context of debt market could be a bond. Security in the context of a stock market could be a common stock or a share. Security in the context of foreign exchange market could be Forex. Okay. So what is that security that I'm talking about? Is basically it represents a claim on the issuer's future income or assets. For example, if you are buying one share of Reliance Industries, therefore you automatically become entitled to any future income that Reliance Industries generates. Okay, so that payment will be made via dividends. Similarly, if you buy a bond, you are entitled to, because bond is a contractual instrument, you are entitled to coupons at fixed intervals of time. Okay, if it's a coupon bearing bond. And of course, you are entitled to a principal repayment at the end of the maturity. Okay. So in this case, bond becomes a debt security that promises to make payments periodically for a specified period of time. Debt market, also known as the bond market, basically allows businesses as well as governments to borrow in order to finance their activities. So again, like I said in the first slide itself, that financial market itself acts as a bridge between the savers and the borrowers, the people who need money. Okay, so if you visualize how debt market may be acting as a bridge, just imagine, just open any newspaper, business newspaper. On any page, you will definitely find a news that somebody has borrowed some money via bonds, via raising, by basically by issuing bonds. Okay, let's say Reliance Industries has issued bonds and it has raised some money. Okay, so therefore you can visualize now that okay, debt market is a bridge, is acting as a bridge between savers and investors, and this is how they are going to raise money. Okay, so ultimately, who is going to give money to Reliance Industries? People like us. Okay, individuals. It can be businesses as well, because businesses also subscribe to bonds of other companies. Okay, it can be governments at times. Okay. Now, in the context of bond market, what is an interest rate? Interest rate is basically the cost of borrowing or the price paid for the rental of funds. This is what interest is. So just at the basic level, just understand that interest rate represents the cost of borrowing. Now let's visualize how interest rates on select bonds has moved between 1950s to 2030. So here on your slide, what you can see is there are three different types of bonds. One is 3-month treasury bill. Second one is US government long-term bond. Third one is corporate BAA bond. So BAA is nothing but rating. So I'm going to come back to this corporate rating at a later point. But for now, just understand that it represents the rating. There are independent rating agencies who actually kind of rate the bonds issued by corporates, which indicates the likelihood of default. Okay. So yeah, again coming back to the basic premise, what we were trying to look in this chart is how interest rates on selected bonds have moved between 1950s to 2030. Okay. So from this chart, we can make out that that instrument could be of two types. Okay. It can be a short-term debt instrument. For example, you have a 3-month treasury bill, or We may also have long-term debt instrument, for example, a 10-year government bond. Okay, and we find that interest rate on 3-month treasury bill is far more volatile. So as you can see, the volatility itself is evident from the chart. Okay, and this interest rate is lower on average than the interest rate on longer duration debt instruments. So which means that interest rate on the 3-month treasury bill is on average or consistently, you can say, is lower than the interest rate offered by let's say longer duration debt instrument. Okay. Now look at the period between 1970 and 1980, which means basically this period, 1970 and 1980, this period. So if you just focus on this period here, 1970 to 1980, so even at the first look, you will find that interest rates are rising during this period. Okay, so some things may have happened between 1970 and 1980 when interest rates are moving this way. Okay, now if interest rates move, either it goes up or in a later period, if you see from during this period, it's going down, it's coming down. Generally speaking, it's coming down. Okay, so either it's going up or going down, which means interest rates is changing. Okay, so if interest rate is changing, this change in interest rate must have affected the cost of acquiring funds for financial institutions. Okay, it would have done so many other things also. For example, if somebody would have taken a loan, home loan, if interest rates goes up, and you know what happens in that case, banks would actually charge you higher on your home loan, right? So if interest rate is going up or going down, it will also is also going to affect the business profit. Okay, changing interest rates would also change the valuation of assets such as stocks and bonds. Okay, now the thing is, can we say that a rise in interest rate is always bad? Generally speaking, we think that okay, if interest rate is going up, we will have to pay more in EMIs. Okay, because higher interest will be charged to us by banks. Suppose we have taken a home loan, interest rate is going up, so it's bad for us. We have taken a car loan, interest rate is going up, so it's bad for us. Okay, but can we generalize this statement? Can we say that generally speaking, a rise in interest rate is always bad? Answer is no. Okay, there can be instances, or there could be people who will be benefiting because of interest rate increases. For example, individuals who have parked their money in a bank, savings institutions, okay, who have made FDs. Now banks would pass on, and assuming that interest is going up and bank is passing on the benefit of higher interest rate, so the person who is like who has made an FD will be earning higher interest rates. So therefore, we cannot generalize that interest rate increase is always bad. Okay? Sometimes it can be good as well. Now come to the second segment of the financial market, which is the stock market. Now this is very, what to say, you can say very popular segment, because even if we are not familiar with the bond market, many of us would be familiar with the stock market, because many of us would maybe investing also. Okay, not directly, then maybe via mutual funds, indirectly investing in the stock market. Okay, so what is stock market in that case? Stock market is a place where we have listing of new shares. Okay, so if you have a company and if you want to list new shares or raise money through IPO, what is IPO? IPO is just initial public offer. So it's a way through which a company, maybe a private company, can become public. So think about Patanjali. It's a private company. If it is not listed on a stock exchange, so you cannot become a shareholder of Patanjali. So again, coming to the instruments or the securities that trade in the stock market, I have already told you, in stock market, the security that trades is a common share, common stock. Okay, so shares of Infosys, Reliance Industries, Tata Motors. Okay, so these are the securities. So what do you understand by the term common stock in that case? Common stock basically represents a share of ownership in a corporation. So it is a claim on the earnings and assets of the corporation. Now, if prices change in the stock market or the stock market becomes very volatile. Again, any change, like I have already mentioned in earlier two slides, that any change in the any segment of the financial market is going to affect the well-being of individuals, it's going to affect the well-being of businesses or corporates, it's going to affect the well-being of the economy as a whole. Okay, so therefore, volatility in stock prices can also affect business investments. Now, we might be wondering why would that happen? Answer is very simple. This is because if the stock prices fall, that would mean that a firm can raise a smaller amount of funds, and so investments in plant and equipment will fall. Okay. Likewise, corporations may raise funds to finance their activities by issuing stocks and selling it to public. Similarly, consider what would happen if stock prices go up. Higher stock prices would mean that consumers would be wealthier. So go back to the earlier example. You had, let's say, invested 10,000 rupees in Tata Motors, and let's say in last 1 year, Tata Motors has gone up, let's say, by 30%. So you're wealthier. Okay. Similarly, somebody has invested 1 lakh and it has gone up by, in some stock, it has gone up by, let's say, 50%. So that person is wealthier by 50,000. Okay. So now there are big investors and traders in the market which do not, basically, who do not invest these small amounts. They have investments in crores. Okay. So in that case, they'll be wealthier. Okay. So let's say somebody has investment of 10 crores and the stock market goes up by 50%, then he becomes wealthier by 5 crores in just a matter of time. Okay. So higher stock prices also means that consumers not only will be wealthier, they will also be more likely to increase their spending, because once they are wealthier, they would like to spend. Okay, maybe they would like to buy a new house, they would like to buy new iPhone, maybe they would like to buy new car, they would like to go on international vacations, international holidays, okay, international trips. So many things, which means that in spending also go up. The stock market is one such market which is tracked widely across the globe. So you will find that across, not just in India, across the globe, there are people who are very, very who keenly monitor the movements in the stock market. So just to make that point evident, I've just taken a snippet of Financial Times, which is basically a leading business daily globally. Okay. So the point that I'm trying to convey by putting the snippet is that any big movement which happens in the stock market is basically bound to draw wider audience, is bound to draw interest of so many investors across the globe. Okay, and therefore it's going to be published in the as a headline. Okay, as you can see, what does the headline say? US plus data record high. It has actually rebounded 50% from March lows. So it's actually, this is somewhere during times. And during the COVID times, as you can see, the stock market has plummeted sharply. So as you can see, this chart is basically, this shows how S&P 500, which is basically a widely tracked benchmark in US, just like we have Nifty and Sensex, in US, widely tracked index of Dow Jones Industrial Average and S&P 500. So as you can see, during the COVID period, how this S&P 500 has plummeted, so which is indicated by the steep decline over here. Okay, so this was around March lows, and then this news came out somewhere in August, and as you can see, it has recovered almost all of the losses is recovered, right? So therefore, the point that the broader picture that I'm trying to give here is that any movements in the stock market is bound to capture attention of so many people, and therefore they will be widely reported in business dailies in the front page itself, as is evident in this news itself. Okay. And why? Because we all understand, because it's going to change the fortunes of so many people. Just imagine somebody investing at this point at the March lows, let's say 1 crore rupees, because there are so many people who do that. And by August, that means in a couple of months itself, the stock market has jumped by 50%. So the person has made within just a few months, he has made 50 lakhs profit for himself. Okay, so it's going to change. It's a place where people can get rich or poor very, very quickly, and hence it receives a lot of attention. The same thing we can clearly make out from the chart that stock prices are again very, very volatile. Okay, so these fluctuations basically shows you how stock market goes down, goes up, goes down, goes up. So this is basically the fluctuations of the stock market. And this, in the earlier slide, we were talking about one of the popular indexes, which is S&P 500. In this slide, we're talking about another popular index, which is Dow Jones Industrial Average, or DJIA. Okay. And again, I have plotted the movements of stock prices as represented by this Dow Jones Industrial Average Index for the period 1950 till 2030. Okay. So it's basically showing how the market moved up and down, the US market moved up and down during this period. Now, there are two prominent events that is captured in the chart itself. There may be many, many, but they may not be so prominent. There may be small ones. But by and large, the two major events that have happened is first is around 1987, somewhere around over here. See, in hindsight, this may look like a small drop, but this was not a small drop. If you go back to that point, which is the year October 1987, what happened was the first time in history, stock market crash, investors saw a severe stock market crash. Okay, when the stock market experienced the worst one-day drop in its entire history. So on that single day in October 1987, this Dow Jones Industrial Average fell by almost 22%. And therefore, this day was labeled as Black Monday. Okay, so you can just understand tomorrow if Nifty tanks by 22%, there will be so much bloodbath on the markets, right? People will be like going mad, crazy. Like in just one single day, you have lost 22% valuation. But this actually happened in US in October 1987, and therefore this is known as Black Monday. And again, somewhere around here, late 2002, as you can see, again this crash over here. This is again the collapse of high-tech bubble. And here the stock market fell by 30%. And of course, you can see during the recession, subprime mortgage crisis, which was triggered by subprime mortgage crisis, stock market fell by almost 50%. So you can look at the steep decline, almost 50%. Valuation gone. So these fluctuations in the stock market is definitely going to affect the size of people's wealth, because see, it's a two-way street, right? It's a two-way street. Just try to understand. All is not well, because somebody, as I rightly in the previous slide, I was saying that if somebody invested here 1 crore rupees, and by August, if the market goes up by 50%, the person gains 50 lakhs in a matter of months. Okay, this is just one side of the story. Okay, the other side of the story is somebody invested here just before the financial crisis of 2008, 2009, 1 crore rupees. Stock market within a couple of months tanks by 50%. He loses 50 lakhs in just a few months. So it's a it's a two-way street. You can see you can lose money as well, severely lose money. So you have to be very, very cautious. So therefore, the point that I've already made is stock market is the place which can change the fortunes of people overnight. And even if you just have to, open some of the business websites, Economic Times, Business Standard, you will, on a periodic basis, encounter news where they say that, okay, so and so stock has run up by 30% in just one session. So and so stock has given you 70% returns in last 1 week, or 80% return in just 1 month. You will encounter these type of news every now and then. Now, let's come to the third segment of the financial market, which is the foreign exchange market. Okay, so this happens to be another major segment of financial market, which is the foreign exchange market. Now, the question is, why is this market needed in the first place? We already have a bond market. We already have a stock market. Then why do we need a separate foreign exchange market? Answer is very, very simple. the reason for the existence of foreign exchange market is foreign exchange market is required because businesses as well as governments as well as individuals, they need to transfer funds from one country to another. Let's say uh, one of your relatives studies in US, is doing, let's say, MS in computer science, for example. Okay, so you need to transfer. Let's say he may be your brother, he may be your sibling, he may be somebody, some of your relative. You need to transfer funds. Okay, so how do you transfer? Because in India, Indian rupee will be valid currency. It will be accepted for any transaction. But in US, that 1 rupee will not. Nobody will be willing to accept that 1 rupee. Just try. If you have just had a chance, I'm sure that many of you would have traveled abroad, would have experienced that. Will that 1 rupee or Indian currency nobody will accept. Okay, and therefore if you go to US, you need to produce US dollar. If you go to Europe, some country, let's say Italy, you need to produce euros. Nobody is going to accept Indian rupees, and therefore there has to be some market where you surrender your own domestic currency and ask for, in exchange, you ask for the currency of that country where you are visiting or where you're going to do that transaction. This is the market which is going to facilitate that transaction. Okay. Similarly, take another example. For example, if a firm which is based out of US is importing few items from another firm based out of Europe, then it has to make payments in euros. Okay, which means that the currency has to be converted from dollars to euros, and it has to be converted somewhere. So this conversion will take place in a foreign exchange market, and therefore this market becomes instrumental in moving funds between two countries. Now, why is this important? Is this any other reason why this segment is important? Why foreign exchange market is important? So, one, I have clearly mentioned that this is going to allow you to exchange currency. Okay, currency exchange will happen. The second reason why this segment of market is important is this market is also important because this is the place where the price of one currency is determined in terms of another currency. Okay, and this rate is known as the foreign exchange rate. Okay, now let us understand the implications of any changes in the foreign exchange rate. For example, how would British consumers be affected because of a decline in the value of pound sterling? So just take a moment to understand what would happen here. You are a British citizen, let's say, and the British currency is pound sterling. Okay? And it has declined in value, let's say vis-a-vis dollar. Okay. So definitely as a British citizen, it will make foreign goods more expensive. And so British consumers will buy less foreign goods and more domestic goods. This will surely happen. Similarly, just think how would an increase in the value of pound sterling affect, let's say, American businesses. Okay. So we are taking this example, assuming that there are only two countries in the world. One is UK, other is US. Okay, you are a US citizen. You are a UK citizen, and your currency is British pound sterling. And let's say for you, domestic currency is pound sterling. For you, the foreign currency is US dollar. Okay. Now I'm saying, how would an increase in the value of pound sterling affect American businesses? Okay, the foreigners, right? How is it going to affect? Let's say Apple. It's definitely going to make British goods more expensive relative to American goods because the pound sterling has appreciated vis-a-vis US dollar. So American businesses will find it easier to sell their goods in US and abroad, and the demand for their products will rise. Okay. Not only that, any changes in foreign exchange rates is also going to affect the profitability of financial institutions as well. So it's very intuitive again. Okay. For example, if foreign exchange rate changes, it will change the value of assets held by financial institutions. Okay. The value of assets may either increase or decrease, so financial institutions will incur a gain on these assets. Similarly, there may be traders in foreign exchange working for financial institutions. So any changes in foreign exchange rates is going to affect the profits made by these traders. Again, let's try to understand how exchange rate of the US dollar has moved during this period between 1970 to 2013. Okay. You can clearly look the chart itself. This figure clearly shows that the value of US dollar relative to other currencies has fluctuated substantially over the years. These fluctuations will have significant impact on the value of imports as well as exports. For example, if you see when dollar strengthened between 1980 and 1985, between this period, dollar is actually increasing in value. It has strengthened. So we therefore use this terminology in this exchange market, strengthening or appreciating, which means one and the same thing. It is increasing in value related to the other currency. So in this case, US dollar is increasing in value related to British pound. Okay. So dollar has strengthened between 1950 and 1985, and again between 1995 and 2000. Somewhere over here, it's again rising. So it's again dollar is strengthening. Okay. So exports of steel fell down. Okay. So although American consumers benefited because foreign goods became cheaper for them. Okay. Now let's say consider the period between 1985 and let's say 1995, roughly this period. So what do you see here? Clearly, you can see that during this period between 1985 and 1995, and again, you can see the same thing over here, 2000 to 2014. Reverse is happening, which means dollar is weakening vis-a-vis the British pound, which means foreign goods become more expensive, but American businesses become more competitive. Now, again, if let's say you're a US citizen, and the chart shows that the value of US dollars relative to British pound. So, in which years would you prefer to visit, let's say, tourist destinations within US, and in which years would you want to visit abroad, let's say London? Answer is very simple from this chart itself. Okay, if you see in the mid to late 70s, and again late 80s and early 90s, which means this period. To look at this period, it would have been relatively more expensive. Okay, it would have made more sense to not travel abroad, as it would have been relatively more expensive. And similarly, when the value of dollar went up, for example, during this period itself, during the early 1980s, travel abroad became relatively cheaper. Okay. During these times, it would have made more sense to visit, let's say, tourist destination in UK, let's say London. Now, we have clearly understood why do we want to study financial markets. Let's now jump to the second question, is why should we study financial institutions, okay, which is different from financial markets. Answer is again very simple. We need to study financial institutions because they play a very, very crucial role in improving the efficiency of the economy. Okay. And if you can, I don't think you can imagine any financial market without financial institutions working in it. Okay, so because without these financial institutions, financial markets would not be able to move funds from people who save to people who have productive investment opportunities. We're talking about the structure of the financial markets. We have different types of financial institutions. For example, we can have a bank. Okay, let's say State Bank of India, ICICI Bank, HDFC Bank, etc., etc. You can have another set of financial institutions, let's say insurance companies, let's say HDFC Life, let's say LIC, okay, ICICI Prudential, etc. You can have mutual funds, which is a third type of financial institutions. So let's say you can have Miri Asset Mutual Fund, you can have Bank of India Mutual Fund, etc., etc. You can have finance companies, for example, Muthu Finance, Manappuram, Cholamandalam, Bajaj Finance, Bajaj Finserv, etc., etc. Now, coming to one of the important financial institution, which is banks. So what do you think is the basic activity of the bank? So in any financial market, these banks, what they do is they just accept deposits and then use the resulting funds to make loans. Suppose you want to make a loan to Apple or Amazon. These are big giants. So as an individual, you won't be able to do that. Okay, because you're not going to the CEO or the CFO of the company and offer a loan. Okay. Instead, what you do is you would just go to some financial intermediary, such as a commercial bank, or you can go to a mutual fund or a pension fund, or let's say an NBFC that borrows funds from people like you and me who have some personal savings. And these financial intermediaries will in turn lend this money to businesses or other entities. So effectively, we are indirectly lending money to businesses through these financial intermediaries. And therefore, these financial intermediaries they become very, very crucial for a well-functioning financial market. Now, we must understand that these financial intermediaries they are very, very crucial for a well-functioning market. The important point that I need to mention here is that financial intermediaries are also heavily regulated. Okay, particularly banks. Why? Because they are working with public money, taxpayers' money. Okay, so this need for regulation also arises from anecdotal evidence, what has happened anecdotally. Okay, for example, look at what happens. What happened when the financial ecosystem seized and produced economic crisis. So what happened during these financial crises? You will witness sharp decline in asset prices. Okay, for example, stock markets tanked. Okay, property prices came down heavily. Okay, so there will be many financial and non-financial firms which were going bankrupt, which were going bust. Okay. Similarly, look at what happened to the U.S. economy during that period, recession period, 2007 and 2009. The U.S. economy was hit by a severe financial crisis. Financial institutions, in general, at that point of time, were reeling under heavy losses because of the defaults in subprime residential mortgages. It actually led to collapse of so many financial institutions, and the most prominent of them was the demise of Bear Stearns and Lehman Brothers. So these two happened to be the largest investment banks in US at that point in time. Now, when you look at the whole structure of financial system, the most important institution is the central bank. So again, central bank is a government agency, and is responsible for the conduct of the monetary policy. In the US, the central bank is known as Fed or the Federal Reserve System. In India, it is RBI or the Reserve Bank of India. So we can think of monetary policy as basically a set of tools that the central banks use to influence the economy and the financial system for achieving few economic objectives. Central banks would try to manage interest rates as well as the money supply in the economy, as well as other activities, ancillary activities that they would be doing. Now, over the period, what we have seen is that this financial system doesn't work as in isolation. Okay, let's say you can't say that okay, US banks are working in isolation with uh, European banks. It doesn't happen in today's world, which are highly integrated. Okay, and you can see that there are growingly interlinkages of global economies. There is growing cross-border capital flows between two economies. Just look at the trade figures. How much trade happens between US and Europe? How much trade happens between China and US? Okay, so this actually leads to cross-border capital flows. Similarly, how much FDI, FII activities happen. Okay, so this leads to increasing cross-border capital flows, and the international financial system has a growing impact on domestic economies. So central bank would keep in mind the exchange rate when deciding its monetary policy. Okay. Similarly, whether there is any restriction on capital flows across border will have an effect on the domestic financial system and the performance of the economy as a whole. Now, coming to the role of banks and other financial institutions, banks are financial institutions that accept deposits and make loans. So, in general, they are known as depository institutions. They accept deposits and make loans. Banks happen to be the largest financial intermediary in our economy. And as I have also mentioned, that they are heavily regulated as well. Why? Because they are working with taxpayers' money. Okay. Financial innovation has actually led to the development of new products and services. There's so much financial innovation that's happening around. Okay, they have made the financial system more efficient. However, there is a dark side to it as well. Okay? Because there are critics who claim that financial innovation was responsible for the 2007-2008 financial crisis. Okay? But on the flip side, on the positive side, there have been drastic improvements in information technology that has actually led to new financial products and the ability to deliver financial services electronically. Okay. Because of this creative thinking on the part of financial institutions, increased profits and even otherwise, economic environment has become riskier. So, what are these different risks that I'm talking about? Risks are that the interest rates and foreign exchange rates may fluctuate wildly. This will lead to wild swings in the profitability of financial institutions with the possibility of financial failure on the downside. This is what we have witnessed during the financial crisis of 2007 2008. The risks were not being managed properly. And what 2008 2007 crisis has taught us is risk management is very, very important. Okay, and therefore, risk management in these financial institutions has become very, very important. So maybe as we go along, we will see how financial institutions they may use some of the derivative instruments, for example, financial futures, options, swaps to manage these risks. See, there are so many risks. You can be you using these derivative instruments. You may be trying to hedge your credit risk. Okay, for example, farmers use these instruments to for hedging. Okay, for example, there is a farmer who has produced wheat, and it knows that by the time of harvest and by the time it goes to market, anything can happen in the market, commodity market, and therefore you need to lock in the price. Farmers, what they will do is they will just look at futures, how the futures are trading, and they will try to sell futures. So essentially, they have locked in a price that will actually, locked in a price for the produce. Okay, or it has ensured what price they are going to get when they actually deliver their wheat to the counterparty. Okay, similarly, for airlines such as Indigo, they may be trying to lock in a price. So they are trying to hedge the risk that the prices will go up. And therefore, because what happens for these airlines, fuel cost is a very, very critical component. If fuel cost rises drastically tomorrow, many of these airlines may be bankrupt, they just go bankrupt. And therefore, they have to use some of these instruments to hedge their risk. Okay. Similarly, banks may want to hedge interest rate risk. Okay. There's so many things. Okay, let's say a mutual fund manager may have to hedge the risk that the value of the holdings don't fall drastically when the market declines, and therefore, let's say they may buy a put or they may write few calls, they may sell few futures, they may do so many things. Okay, so the nature of risk may be varied. It depends on the context that you are studying, and therefore, accordingly, the instruments will also change. Now let's come to the overview of financial system. Okay. Again, just take a very simple and naive example. Suppose you have a wonderful business idea, okay, but you do not have funds. Okay. So tomorrow, let's say I want to start a business. I don't have funds, but I know that there are some of my friends who have plenty of money. Maybe they have inherited from their parents, etc., etc., or for whatever reason they have funds, but I don't have. But I have a business idea. Now, what if I and my friend come together? Okay, so that my friend provides me the funds, my business idea can materialize. Similarly, what is a gain for my friend over here? My friend will earn a high return on his investment. So now what has happened here is we don't have a formal market, and therefore these transactions become very, very difficult in the absence of a formal market. Okay. But luckily, we have a formal setup in place, and thanks to these financial markets, for example, a bond market or stock market, as well as the financial intermediaries, banks, etc., such transactions they become very, very easier. So what these intermediaries will do is they will bring the two parties together. Okay, party who has funds and the party who has a business idea, they can be uh, they can be just allowed to interact with the help of this financial system. Okay. Now, coming to the functions of financial markets, so we must understand that financial markets and financial intermediaries they are crucial to a well-functioning economy. Why? Because they channel funds from those who do not have any productive use for them to those who actually have some productive use for them. So, very, very broadly speaking, we can have two sets of parties here. okay, which we have clearly labeled here. One set is called the lenders or savers. Why lender? Because he's going to lend money. Now, who is the one person who is going to lend money? Who has saved some money? Okay, therefore, lender savers one set of person. Other set is borrower, who is borrowing money. Okay, he's the person who is going to spend on some project, some business idea, etc. So he happens to be a borrower spender. So we have two parties. There are individuals who save money, but they do not have investment opportunity for those funds. And then there will be individuals who do not have sufficient money to fund their investment opportunities. So they are borrowers and spenders. Now, who are these lenders or savers? Who are these borrowers or spenders? So, who are these lenders or savers who need money for their business ideas? And who are these? Sorry, who are these lenders or savers who have idle funds? And who are these borrowers or spenders who need money for their business ideas? So, you know, uh, you can have on the lenders or savers side, you can have households, you can have business enterprises, even state governments, local governments may save some money, and therefore they may have surplus funds which they may be willing to lend. Okay, therefore they can be lenders or savers. They can act as lenders. Okay. On the other hand, who are these borrowers or spenders who need money for the business ideas? Most important borrower or spenders are businesses, corporates. Okay, so somebody wants to expand their business, they would definitely need to have money. Either they can just go with an IPO, they can just issue a bond and raise the required amount of money. Borrowers can also be government, and we will see that why and when and how governments borrow money in this financial market. We'll talk about that as well. Households may also sometimes need to borrow in order to buy a house or a car. Okay, so these are individual borrowings. Suppose somebody wants to pursue a degree and an MBA, the person will borrow money from bank, education loan. Okay, so so it becomes a personal borrowing. Okay, or a household borrowing. Somebody wants to buy a new house, new car, they borrow from a bank. Now, this transfer of funds between your lenders or savers to the borrowers may take place through one of the two routes. So one is basically a direct finance route. The second one is the indirect finance channel. So it may either happen through one of the two routes. So in the direct finance route, in the first channel, as you can see, the funds they are channeled through intermediaries. So which is sorry, it happens directly in the financial markets. So borrowers can just borrow directly from lenders in any financial market, let's say bond market or stock market, by just issuing an instrument. So if the person is borrowing in a stock market, he have to issue equity stocks. Let's say through FPO, through IPOs, you can just borrow in the stock market. Similarly, if somebody wants to borrow in the debt market, then he will have to issue debt. Okay, debt instruments. Okay, and again, I have already explained to you that these instruments or securities are nothing but these are claims on the borrower's future income or assets. On the indirect finance side, borrowers borrow indirectly from lenders, but this borrowing doesn't happen directly. So in the earlier case, you're just going to the financial market, you are issuing equity or issuing debt, and you're borrowing, but in this case, you don't do that. You borrowing happens through some financial intermediary, and you are definitely going to issue financial instruments which are claims on the borrower's future income or assets. So if the borrower borrows funds directly from financial markets by selling securities, it will be termed as direct finance route. On the other hand, if a financial intermediary, let's say a bank, borrows funds and uses these funds to make loans, this will be termed as an indirect finance route. So this is broadly explained using this chart. Okay. So what is this chart showing you? It is just showing you how the fund flows through the financial system. So you have both the channels shown on this chart itself. Okay, so you have this chart is showing you both your direct finance route as well as indirect finance route. Okay, so direct finance route is shown in the light blue color at the bottom. So this is basically the direct finance route. As I have already told you, no intermediary is involved, and therefore it's known as the direct finance route. So borrower, a business firm or a corporate, can just issue an equity or a debt instrument in this market and borrow money from this households or business firms or governments or foreigners as well. So, in general, these securities will be treated as assets for individuals who buy them. Okay, why they are treated as assets for individuals who buy them? Because it gives them that entitlement on the future income and assets of the borrowing entity. Okay, um, but the same security will be considered a liability for individuals or entities that sells them. Take for example General Motors. Suppose General Motors wants to manufacture electric cars, so it decides to build a new factory. So General Motors borrows money from savers by selling bonds to them. So in fact, it's a debt security that promises to make payments periodically for a specified period of time. So alternatively, what it can do is it could have sold General Motors stocks, which would have entitled the buyers of the stock to a share of companies' future profits and assets. So this channeling of funds becomes very important because even if you have surplus funds, you may not have investment opportunities for those funds. So therefore, this channeling of funds becomes very, very important. Now that we understand the role of financial markets, let us talk about the structure of financial markets. So broadly speaking, we can classify financial markets in so many ways. For example, we can differentiate between debt and equity markets. Just read this line, what it is saying. In a tumultuous year for debt market, it found increased demand from lenders as it reshaped its business to seize future opportunities. So basically, again, an example of what I have been discussing, how changes in these different segments of financial market is going to affect businesses. And this also presents opportunities for these businesses to actually, let's say, expand to new geographies or introduce new business lines, new products, etc. So this is what has happened itself. And in the second line itself, it has made it very clear that Reliance Industries has been one of the India's standout corporate issuers for decades. But in recent years, it has changed the profile of both its business and its borrowings that has shown its success with jumbo issues in 2023. Okay, so therefore, this is basically a direct finance channel because here they are issuing bonds. So this will be evident through the news itself because I don't want to go through the entire news. I'm just showing you one typical example because I've given you enough hint that where to look for it. Okay. Let me just quickly glance through this. Let me show if you have concrete written statement here. See here. Reliance managed to print a 200 billion 10-year bond in November. This issue, India's largest by a non-financial corporate, was significantly oversubscribed and drew demand from insurers. So see, in this case, Reliance Industries happens to be the borrower or spender. And who are these lenders or savers? They happen to be insurers. They happen to be pension funds. They happen to be mutual funds. They can be non-bank lenders. Okay, so this is a good example of a direct finance channel where without the presence of any financial intermediary, this channeling of funds from the savers or let's say lenders is happening to borrowers or spenders. So this is one example. Let me give you another example. And this example now is about Alok Industries raising 7,000 crore from Reliance and two banks. So this is another example, which is, let's go through that example to understand what is happening there. So Alok Industries has raised 7,000 crore from parent Reliance Industries and two lenders were Axis Bank and State Bank of India. Now these lenders are nothing but intermediaries. Okay, so if it has borrowed money from banks, so it becomes indirect finance channel, right? Because these intermediaries has helped collect money from lenders or savers. Okay. So now I have given you example of both direct finance channel and indirect finance channel. And I'm very, you just have to open any business news daily and you have to just glance through it on a daily basis. You'll find n number of examples on a daily basis. If it comes from any financial intermediary, then it's an indirect finance. That intermediary could be a mutual fund, it could be a pension fund, it could be a bank, etc. Okay, and if it raises money by issuing securities, for example, by issuing bonds or by selling equity in the form of an IPO, but Reliance is already listed. Let's say it comes with an FPO, or let's say some other thing. In that case, by selling equity, it becomes a direct finance channel. So right now I'm looking for any news, if I have any current news on borrowings, direct finance channel or through indirect finance channel. Right now I can't find, but so you need to develop this habit of going through business dailies. I do that. Okay, so I keep encountering those. So unfortunately today I can't spot anything, but you will find almost on a daily basis. So I just open Economic Times. Let me just check once with Business Standard also, and let me see if we have something on Business Standard. Yeah, I have one thing. I have one thing. Two interesting things I found on Business Standard website. Let me share it with you. Two interesting things I found. See, one is this: What idea gets board not to raise 2,000 crores from Aditya Birla Group? This is one capital raising, but this is going to happen from Aditya Birla Group. So I don't know. You have to just click on the news and understand the nitty-gritties. Okay, most likely it will be one of the two channels. You just have to go through the nitty-gritties. But one more thing that I was pointing out earlier in this session was that how stock market changes the fortunes of people very, very quickly. For example, as you can see, free news itself, Coforge, Tech, Mahindra, Sonata can rally up to 14%. So this is something else. This recently listed stocks soared 76% in 50 days, up 116% from the show price. So see how fortunes of the individual who will invest will change very, very quickly. In just 50 days, he is going to earn 76% returns on his investments. Okay. Similarly, look at another news, which is Zomato hits new high in subdued market. Stock zooms 55% in this calendar year 2024, which means in this just 3 months, if you had just invested your money in Zomato, you would have made 55% return on your investments. See how quickly your fortunes can go up, right? So this is one point which I was referring to in my previous discussion. Okay, so the thing is, you need to actually be on a hunt for these news, and this will only be possible if you just develop this practice of reading newspaper daily, almost on a daily basis. Otherwise, it's very difficult. So I was like talking about how do you structure these financial markets, right? So there are so many ways in which you can structure this financial markets, okay, or you can see in so many ways you can classify these financial markets. So broadly speaking, we can classify financial markets in different ways. For example, in the current slide, we are saying that okay, let's classify financial markets between debt market and equity market. Okay. The other classification could be a primary market and secondary market. Okay. Other classification could be exchange traded market versus over the counter market, and so there are so many ways actually. Okay, but let's focus on the current classification that we are seeing on this slide. So let us just make this distinction between a debt market and equity market. Okay, so if you are an individual or if you are a business owner, okay, and you need funds, you have two choices in that case. Okay, either you can go to a debt market or you can come to an equity market. So if you go to a debt market, we'll find that there are debt instruments such as a bond or a mortgage. So these are basically contractual agreements between the borrower and the lender. So the borrower agrees to pay the debt holder a fixed amount at regular time interval until the bond maturity. And at maturity, what will happen is the borrower will repay the principal amount. Now, we may have a short-term debt instrument with maturity less than 1 year, or we may have long-term debt instruments with maturity of 10 years or more. Okay? And then there are intermediate term debt instruments that have a maturity between 1 and 10 years. So you may also go to equity market for raising funds. Generally, firms borrow in the market by issuing equity such as common stock. So common stock, as I have already explained to you, it represents a claim to the share in the net income and assets of a business. So net income basically means income after expenses, all business expenses and taxes. Okay. So let's understand this through a simple example. Let's say there's a firm that has issued 100 shares of common stock. And if you buy 10 stocks in the company, then you are entitled to 10% share in the profits as well as assets of the company. Shareholders also receive periodic dividends because stocks have no maturity date. They are considered long-term securities. So by buying shares in a company, you become a fractional owner of the firm. That means you own a portion of the firm. You also get voting rights. Also, you can vote on important issues that comes up in the board meetings. You can also elect the board of directors. Also understand that a share of common stock is an asset for the shareholders, but it is a liability for the firm. For example, if you talk about a share of Microsoft, it will be considered an asset for the owner or the shareholder. That means if you buy a share of Microsoft, it will be an asset for you, but it will be a liability for the company. That means Microsoft. Okay. Now, if we compare the size of two markets, you will realize that which market is bigger. Look at this pie chart over here. What does it show? It shows clearly that debt market is a much bigger market. Okay, so this figure was taken at the end of 2015, and it clearly shows that the value of debt instruments was around 39.7 trillion US dollars, while the value of equities was 25.1 trillion dollars. So this is one way of classification. Now let us consider the difference between primary and secondary markets. So we know that primary market is a place for the issuance of new securities such as a bond or a stock. For example, an IPO would be an example of primary issuance. On the other hand, a secondary market, it just facilitates the trading of existing securities. So secondary market allows for a change in the ownership of securities, and a primary market will provide funds to the issuer of securities. But a secondary market transactions, your trading shares which are already issued in the primary market. So it's just a place where securities which have been previously issued can be resold. Okay. Now there are so many intermediaries involved in the market. For example, if we talk about the primary market, one such intermediary is the investment bank. What is an investment bank? Or give me examples of investment bank. Investment bank example could be Goldman Sachs. It could be Morgan Stanley. Okay, Nomura, etc., etc. So they assist in the initial sale of securities in the primary market. So what is the role of investment banks here? They will just underwrite issues. Now, where did this word underwriter originated from? So earlier there used to be a practice that each risk taker would write their names and the total amount of risk that they were willing to accept. Of course, they used to charge a premium for it. Okay. So by underwriting an IPO, the investment bank in effect provides the guaranteed selling price to the firms issuing new shares. So in US, there are two major exchanges which provides an active secondary market. One is your NASDAQ, which is also known as New York Stock Exchange. It's known as NASDAQ. It's known as National Association of Securities Dealers Automated Quotation System. And then, of course, you have NYSE, which is New York Stock Exchange. Okay. So all the previously issued shares will be traded on these two exchanges. Foreign exchange markets, futures markets, options markets, they are other examples of secondary markets. So towards the end, maybe once the course ends, I think in a separate module, we'll talk about market microstructure, where we will discuss the role of brokers and dealers and how they also play a crucial role in the secondary market. For now, let us just understand that brokers are intermediaries. They act as intermediaries. They represent both buyers and sellers. Okay. On the other hand, dealers, they engage in market making in these securities. They buy and sell on their own accounts. Dealers exist not just in equity markets, but in bond markets as well. And these dealers help markets operate continuously. So bond markets in particular, they are overwhelmingly a dealer-operated market. Because of a lack of natural liquidity in such markets. And one important difference between primary and secondary markets, from the point of view of transfer of funds, is that the person who sells a security in the secondary market receives money in exchange for the security. For example, if you sell a share of Microsoft to me in the secondary market for say $100, you will receive $100, but Microsoft does not get any money. Okay, that means Microsoft that has issued the security acquires no new fund. Microsoft will receive money only when it will issue new shares in the primary market. Main function of a secondary market is just to provide liquidity to the listed securities. So they will enable the owner of a security to easily convert the securities into cash through stock exchanges. So for example, if I own 100 shares of Infosys and if I want to sell it, so I can easily sell those 100 shares on NSE or BSE and get in cash in return based on its market value, whatever the price is trading at on these exchanges. So this I have already talked about, that firms do not receive any money in the secondary market, and secondary market exists only to provide liquidity so that already issued shares may be bought and sold on the stock exchange. Secondary market also helps in establishing a price for these securities. So primary market deals with new issues, while secondary market is meant for trading in outstanding or existing securities. And that means it just serves as a price discovery role. The other way to categorize secondary market is we can classify them as either exchange traded markets or over the counter markets. So government securities market is an OTC market or over the counter market. So in an OTC market, spot trades are negotiated as well as traded. Payment as well as delivery is made immediately. While in an exchange traded market, trading takes place over a trading cycle. There are some differences when it comes to how buying and selling of securities takes place on these markets. For example, an OTC market has no central trading location. So what investors will have to do is they will have to visit or call their OTC dealer or use some sort of computer-based electronic trading system linked to the OTC dealer. And when it comes to stocks of companies, some of them may be traded over the counter, but majority of them are traded on electronic exchanges. But when it comes to government bond market, at least in US, we know that they primarily operate as OTC market, and they have a much larger trading volume as compared to New York Stock Exchange. So you will find that some 40 odd dealers, they have established a market for these securities, and they will be ready to buy and sell US government bonds. Other instruments that are traded over the counter include a certificate of deposits, federal funds, bankers' acceptance, foreign exchange, etc., etc.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
We can also classify financial markets based on the maturity of these securities traded in each market. So financial markets are composed of money markets and the capital markets. Money markets deal with debt securities that pay off in the short term, usually less than 1 year. On the other hand, capital markets deal with long-term debt and equity shares. So securities trading in capital markets will generally have a maturity of 1 year or more. So we also need to understand that money market securities, they are more widely traded than the long-term securities, and therefore they are more liquid. Not only that, historically it has been observed that short-term securities are less volatile, which means we will observe less fluctuations in prices than the long-term securities. And this also means that short-term securities are relatively safer investments. So it's a usual practice with corporations as well as banks that they will park their surplus money in money market instruments. So this helps them earn interest on surplus funds. Now, because international capital markets are developing rapidly, which means orders, payments, and securities can now be transmitted from one market to another almost instantaneously. So I can give one example here. Earlier, Indian investors could only buy or sell stocks listed on Indian stock exchanges, particularly NSE and BSE. But over the last few years or so, you have this facility that even sitting in India, you can just buy stocks which are listed on US exchanges. For example, you can buy a stock of Google, Apple, Microsoft, Facebook. You can buy all those stocks sitting in India. So this is an encouraging trend that global markets have been experiencing. And this is characterized by increasing cross-border financial flows around the world. Financial institutions, particularly banks, they have expanded their activities geographically. They have started acting as an intermediary to channel funds from lenders to borrowers across national borders. So before the 1980s, US market seemed to be a much bigger market and it used to dominate global financial markets. But the extraordinary growth of international markets has taken that uh, dominance away from US markets. Again, deregulation of foreign financial markets has played a huge role here. This has enabled foreign markets to expand their activities across national borders. So, take for example, international bonds. So, these bonds are traded outside the country of the issuer. Okay. International bonds are either foreign bonds trading in a foreign national market, or they may be euro bonds which are trading in the international market. So Eurobonds basically are long-term unsecured debt securities, usually fixed rate instruments. So these are targeted at high net worth individuals as well as institutions, and they are listed on stock exchanges such as Luxembourg or London to provide liquidity. So Eurobond will find that it's usually denominated in a currency other than that of the country in which it is sold. If, for example, it could be a bond denominated in US dollars but sold in London. Okay. Eurobond market is a very significant market. Almost 80% of new issues in the international bond markets are Eurobonds. And this market is now even bigger than the US corporate bond market. Another important financial market is the Euro currency market, which is a variant of the Eurobond market. So multinational banks are very active in the Euro currency markets. They basically gather deposits and make loans, usually in Euro dollars. So you can think of it as a foreign currency which is deposited in banks outside the home country. For example, if US dollars are deposited in foreign banks outside the United States or in foreign branches of US banks. So let's make this difference clear, right? A bond which is denominated in euros is called a euro bond, but the condition is that it has to be sold outside the country that has adopted the euro. In fact, if you look at the statistics, most euro bonds are not denominated in euros, but they are instead denominated in US dollars. Similarly, if you talk about euro dollars, they have nothing to do with euros. They are instead US dollars, which are deposited in banks outside the US. Also, we have to remember that when it comes to world stock markets, US stock markets have traditionally been the largest market in the world, but foreign markets across the world are slowly catching up. And in fact, so much that the mutual funds in the US, they have started specializing in trading in foreign stock markets. In fact, if we just go and you will find so many international mutual funds, right? American investors now not only pay attention to Dow Jones Industrial Average, but they also look at stock price indexes for foreign stock markets, particularly Japan. That is, an American investor tracks the Nikkei 300 average, FTSE 100 share index, which trades in London, etc., etc. So this is basically the result of internationalization of capital markets. So let us actually look at some of the major stock market indexes across the globe. This is how it looks like. So you have the Dow Jones Industrial Average, as I have already been talking about. This is again based on a portfolio consisting of 30 blue chip stocks in the US. The weights given to the stocks are proportional to their prices, and the CME group trades two futures contract based on the index. One has a notional value of $10 times the index, and the other, which is more popular, which is known as the mini Dow Jones Industrial Average, has a notional value of $5 times the index. And this is a mini contract which trades most actively. So that's one index. Okay, the other index is S&P 500 index. Again, it's just a portfolio of 500 different stocks. If you look at the composition of what are those 500 stocks, you will find that there are 400 industrials, 40 utility companies, 20 transportation companies, 40 financial institutions in that basket. And the weights in the stock in the portfolio at any given time, they are proportional to the market cap. Okay. Stocks are those of largely publicly held companies that trade on NYSE, Euronext, or Nasdaq OMX. Similarly, the third index is Nasdaq 100. Again, as the name itself indicates, this is a portfolio of 100 stocks traded on the Nasdaq exchange, and weights are proportional to the market capitalization. So the CME group trades two futures contract. One is $100 times the index, and other, which is a mini Nasdaq 100 contract, is on $20 times the index. So mini contract trades most actively. Some futures contract on indices outside the United States are also traded actively. Okay. So one example will be a contract on CSI 300 index, which is basically it's a Chinese index. Okay, so it's a market capitalization index of 300 Chinese stocks, which trades on the China Financial Futures Exchange (CFFEX). Okay, moving globally, you will find that these are some of the major stock market indexes across the globe, and the list is includes thousands industrial average, also known as DJIA. We already know this is the index of 30 largest publicly traded companies in US. Then you have the S&P 500, which is the index of 500 largest companies trading in US. Then you have Nasdaq Composite, which is the index for all stocks traded on the Nasdaq stock market. You have FTSE 100. FTSE is pronounced as FTSE. Okay, so this is an index of 100 most highly capitalized UK companies which are listed on London Stock Exchange. FTSE stands for Financial Times Stock Exchange. Then you have DAX, which is the index of 30 largest German companies trading on the Frankfurt Stock Exchange, Germany. Then you have CAC 40, which is the index of largest 40 French companies traded on Euronext Paris. Then you have Hang Seng, which is the index of largest companies trading on the Hong Kong stock markets. And finally, you have the State Times, which is the index of largest 30 companies trading on the Singapore Stock Exchange. So these are basically the prominent indexes across the globe. And if you look at the global picture, why US capital markets have declined in prominence is you will find that US earlier used to have dominance in many industries, particularly in the automobile sector, in the consumer electronics sectors. But you'll find that so many other companies have emerged which are actually directly competing with these companies. For example, I can just take one example, which are the US automobile manufacturers. I think General Motors is one of them. But in India, if you just talk about what are the different automobile manufacturers which are who sell cars more prominently on Indian roads, you will find you have Kia, which is a Korean company. Okay, Kia has so many cars, Kia Seltos, okay, and whatnot. I think Kia Carens, Carnival, so many. Okay, similarly, you have Hyundai, which is another Korean company. So you have so many cars, Korean cars running on Indian roads. For example, you have what? Creta, Venue, you have Santro, you have I-20, etc. You have again Alcazar. Okay, so these are so many Korean cars flying on Indian roads. Similarly, Chinese car talk about Morris Garage. Okay, you have so many Morris Garage cars. Astor, for example, Gloucester. Then you have many other prominent brands that is not coming to my mind right now. I think Hector. Yes, Hector is another one. Okay. Likewise, German cars, are flooding Indian roads. All these Audis, BMWs, these are what? These are German cars, right? Likewise, what else? Japanese cars, of course, the Toyotas. These are all Japanese cars running on Indian roads. Or let's say urban cruiser. Okay, Toyota urban cruiser. These are all Japanese cars. Innova. So Japanese cars running on Indian roads. Okay, what else? So basically, I want to just highlight the point that US used to have this dominance in the automobile sector, but you can clearly see that you will hardly find General Motor cars on Indian roads, whereas you find so many German cars, so many Japanese cars, even Honda City. These are all Japanese cars, right? Or Honda Elevate, so many other Honda cars. These are Japanese cars, Korean cars, Japanese cars, Chinese cars. Okay, so definitely you can make a clear picture. Even in real life, you can clearly see that US has lost its dominance how badly in the automobile sector. Even if you talk about consumer electronics, just take one good example. Let's take the example of smartphones. iPhone, you know how Samsung smartphones give tough competition to iPhones. Okay, So Samsung Galaxy Ultra, they have launched so many models, and look at the kind of competition that they are giving to iPhones. Okay, similarly, you have other brands. Okay, so clearly, the point that I'm trying to highlight is US, although it used to enjoy a dominance for a good period of time in these so many industries, but now it's losing dominance primarily because of competition that it is facing from so many other companies. So these are some of the major reasons if you want to understand why on global footprint of US capital markets is kind of missing or coming down. The answer is it is happening because of new technology in foreign exchanges. It's happening because post 9/11, US regulations have been made very, very strict. So companies find it easier to operate outside US than in US. Okay. Third reason is also that there's a greater risk of lawsuit in the US that companies, they can face a greater risk of lawsuit if they operate in the US. Yes. Function of financial intermediaries, indirect finance. We now turn our attention to the top part of figure 2. Yes. So, yeah. So now what we are doing is we're just trying to understand the functions of financial intermediaries, which is the indirect finance. So I'm trying to zoom. I'm just trying to leave the indirect finance, and for a bit, I'm trying to zoom on the first part, which is this part here, which is the indirect finance part here. Okay, this part over here. So if you just focus your attention to this top part of this figure, which means the indirect finance, and we have already discussed this in the previous session that funds will flow from, these are the borrowers, to lenders via financial intermediary. Such these financial intermediary most likely can be a bank. However, they can be other financial intermediaries as well. Okay, and this process of indirect finance using this financial intermediaries is called financial intermediation. And this is intermediation. Okay, so what we need to understand here is that financial intermediaries are a far more important source of financing for corporations than the securities market. Okay, so in some countries you will find that this channel is very, very predominant channel compared to the second channel, the direct finance channel. And in few slides from now you will see some statistics which actually supports my point that I'm making right now. Okay, which is that this channel will be far more important in some countries. However, what we find in real life is that media gives far more importance to this channel, because in the Financial Times paper also we saw that how stock market movement actually made it to the headlines. So that is there. Okay. So to understand why financial intermediaries are so important in financial markets, we need to understand few things. We need to understand the role of transaction cost. We need to understand risk sharing. We need to understand information cost in financial markets. So first of all, transaction cost. What is transaction cost? Transaction cost is basically the cost in carrying out any financial transaction. For example, if you are transferring a certain amount of money from one account to another account, the bank will usually charge you some fees. Okay. Similarly, when you go to a bank to prepare a demand draft, okay, the bank will charge you some commission. So these are some examples of transaction costs. Now, what typically has been observed in any economy is that as the size of financial intermediary becomes bigger and bigger, they eventually start enjoying economies of scale, and that allows them to charge lower transaction costs, which means that these intermediaries enjoy economies of scale. Okay. Financial intermediaries are also better able to develop expertise using lower transaction costs. So because of these benefits that financial intermediaries derive from the economies of scale, it may reduce its transaction costs. And I think this point is well explained over here. Okay. So as we can see that these financial intermediaries will in turn pass on some of the benefits of lower transaction costs to their customers by providing them with liquidity services. For example, banks may provide depositors with checking account that enable them to pay their bills easily. Similarly, depositors can earn interest on checking and savings account and yet convert them into goods and services whenever necessary. This I have already explained that how using low transaction costs, financial intermediary benefits from that low transaction cost. and it can actually pass on that benefit in the form of some liquidity services, okay, which actually helps customers conduct transactions. Okay, for example, banks provide depositors with checking accounts, which means checkbooks, okay, that enable them to pay for the risk easily by just writing a check and depositing it in any other bank. Okay. Similarly, depositors earn interest on checking and savings account and yet still convert them into goods and services whenever necessary. So this is a point which I've already explained. So the thing is that because of the scale at which some of these intermediaries operate, they're able to spread the risk across different entities. Yes, here. Yeah, this is what I'm talking about. They're able to spread the risk across different entities. And this is that actually this process is known as risk sharing. Okay. For example, financial intermediaries, they create and sell assets with risk characteristics that suit their customers and then use those funds, using those funds they acquire, they purchase other assets that may have far more risk. Okay, so we need to understand that risk sharing benefit both financial intermediaries as well as private investors. Financial intermediaries gain because they're able to earn a spread between the returns they earn on risky assets and the returns they pay on less risky assets. Similarly, investors benefit from risk sharing because they're able to invest in a better diversified portfolio than would otherwise be available. So, in this process of risk sharing, banks may be transforming some of these risky assets into safer assets for investors, and this process is known as asset transformation. For example, banks may just convert short term liabilities, that is, demand deposits, into long term assets by providing loans and thereby transforming maturities. Okay. Other channel through which financial intermediaries may be promoting risk sharing is through diversification. Okay. In fact, you have heard this old saying that you should not put all your eggs in one basket for risk sharing. So financial intermediaries follow the same principle for risk sharing. For example, intermediaries like banks may engage in diversified lending practices. Banks may lend money to high risk entities, and by pooling with low risk loans, they may be able to achieve higher yields. Low transaction cost allows them to buy a range of assets, pool them, and then sell rights to those diversified pools to individuals. I think this point, I just skipped the slide. So this clearly shows the thing that I was mentioning earlier, that there are studies, ample studies, which actually show that in some countries, for example, US, Canada, UK, as well as other developed nations, they usually obtain funds from financial intermediation and not directly from capital markets. So, for example, in US, Canada, UK, this first channel will be very, very prominent. So this is what this slide is clearly mentioning. Similarly, in Germany and Japan, financing from financial intermediaries, which is basically an indirect finance channel, exceeds capital market financing tenfold. So again, in US, Canada, UK, Germany, Japan, the indirect finance channel is more prominent. In fact, it is 10 times more prominent in Germany, Japan. Okay. And relative use of bonds versus equity differs by country to country. So the context may change if we just move from one country to another country. So this is the point that I was highlighting in the previous slides. Okay. So far, what we have understood is that the role of financial intermediaries is to create a more favorable transaction terms than that could be realized by lenders and borrowers dealing directly with each other in the financial market. So financial intermediaries achieve this using two steps. First, they obtain funds from lenders or investors and they lend or invest those funds to those who need them. So let's take two examples here. So in the first example, consider a commercial bank, let's say State Bank of India, which is a type of a depository institution. So we know that a bank accepts deposits from individuals, corporations, and governments, and these depositors are the lenders to the commercial bank. The funds received by the commercial bank becomes a liability of the commercial bank, and the bank till then lend these funds by either making loans or by buying securities. So the loans and securities becomes the assets of the commercial bank. So let's take another example. So consider a mutual fund, which is a type of a regulated investment company. So mutual fund accepts funds from investors who in exchange receive mutual fund shares. Now, mutual fund invests those funds in a portfolio of financial instruments. So in the two examples that we have just seen, the financial intermediary transforms financial assets that are less desirable into other financial assets which are more widely preferred by the public. Another reason financial intermediaries exist is to reduce the impact of asymmetric information. Now, what is asymmetric information or information asymmetry? Information asymmetry refers to the fact that in real world, information does not flow smoothly. Some people will have access to information that others do not have. Okay? So in the case of financial services, this means that those providing the financial services do not always know as much as they would like to know about the person to whom they are providing the service, which means that one party often does not know enough about the other party to make accurate decisions. So this inequality is called asymmetric information. So the presence of information asymmetries in financial market explains, at least in part, why financial intermediaries and indirect finance plays such an important role in financial markets. So when lending money, it is important to know something about the person who is borrowing to make sure that they spend the money in such a way that they will be able to repay the loan and to keep track of them and make sure they don't run away without repaying. So because of this, intermediaries do not provide financial services to everyone that needs them. That is, even though these intermediaries may have enough funds at their disposal, they choose not to disperse them to potential borrowers whom they don't know well enough. Okay, especially when it is too expensive to get the information they need. So, to better understand the information asymmetry in financial markets, consider the relationship between a borrower and a lender. So a borrower usually has better information about the potential returns and risks associated with investment projects than the lender. So as we will see next, that this lack of information will create problems both before and after the transaction is entered into. So the two most important results of asymmetric information, which is relevant to financial services, are known as moral hazard and adverse selection. So moral hazard is a problem created by asymmetric information after the transaction occurs, whereas adverse selection is a problem created by asymmetric information before the transaction occurs. So adverse selection basically refers to the fact that it is often the people whose activities are particularly risky who take high interest loans or buy insurance. So because it's not possible for lenders or insurance providers to be sure how risky their customers' behavior is, they have to use various mechanisms to screen potential borrowers. So these methods are inevitably imprecise, which means that some potentially sound customers are rejected. So adverse selection says that potential borrowers who are most likely to produce an undesirable outcome will be the ones who most actively seek out a loan, and therefore they are more likely to be selected. And because of this adverse selection, it is more likely that loans will be made to borrowers who are less likely to repay, which represent bad credit risk. Lenders may decide not to make any loans, even though there may be many borrowers who are more likely to repay, which represents good credit risk. Now, consider a simple example here to understand why adverse selection exists. Assume that there are two borrowers available to whom you can lend your money. Let's assume borrower A and borrower B. Okay. Borrower A is a conservative person, uses the borrowed money wisely to invest in projects that will pay back surely. On the other hand, borrower B takes excessive and unnecessary risk. He wants to invest the borrowed money in some way, in some very risky scheme that promises to make him rich quickly. So because the scheme is very risky, if he invests the borrowed money in that scheme, he is almost sure of not getting back that amount. Okay. Now, which of the two borrowers do you think is more likely to come to you asking for a loan? Borrower B, of course, because he has so much to gain if the investment pays off. However, you would not want to make a loan to borrower B because the probability is high that his investment will turn bad and he will not be able to pay you back. Now, suppose you knew both the borrowers very well, which means that there was no information asymmetry. Then you would not have a problem because you would not lend to borrower B. But if you don't know the borrowers well, That means in the presence of information asymmetry, you are more likely to lend to borrower B than borrower A because borrower B would be repeatedly asking you for a loan. So, because of the possibility of adverse selection, you might decide not to lend to either of the borrowers, even though there may be times when borrower A, who is a good borrower, might need a loan for a worthwhile investment. Now, coming to moral hazard can arise when someone's behavior changes based on their access to financial services. Okay, for example, a business person may make a riskier investment after taking a loan with a high interest rate in order to just get a higher rate of profit and so repay the loan more easily. So in this case, high interest rates can cause risky behavior. Okay. Another example is when a person who has taken out insurance against their car being damaged will drive less carefully because they know they will not have to pay for it in case of accident. Okay, so those providing the financial services have to work out ways to prevent the users of the service acting in this way. So they may require other information about the clients that can reassure them that they will not do risky things. They may require certain forms of assurance. For example, they want collateral for loan takers or a deductible for someone taking insurance. Or they may simply decide not to lend to certain clients about whom they are not confident. So moral hazard is created by asymmetric information after the transaction has occurred. So you can say that it is a risk that the borrower might engage in certain immoral activities that will make it more difficult to pay the loan back. Suppose that you had made a $1,000 loan to another borrower who needs the money to purchase a computer so that he can set up a profitable business. So once the borrower receives the amount, he is very likely to slip off to the track and play, let's say, horses. So if he bets on 20 to 1 long shot and wins with your money, he's able to pay back your $1,000 and live well with the remaining $19,000. But if he loses, you don't get your money back. So borrower therefore has an incentive to go to the track because he gains $19,000. So if you knew what the borrower was up to, you would prevent him from going to the track and he would not be able to increase the moral hazard. However, because it is hard for you to keep track of his activities because of information asymmetry, there is a good chance that the borrower will go to the track and you will not get your money back. Now, because of this moral hazard, you may be discouraged from making that $1,000 loan to the borrower, even if you were sure that you will receive your money if that money is used to set up his business. So these are two problems that arise because of information asymmetry. Now coming to economies of scope and conflicts of interest, we know that intermediaries, they often offer a range of services, specialized services to clients, which actually enables them to enhance their products to cater to the requirements of different types of clients. For example, when commercial banks are lending out money, they can customize the loan packages to suit small and large borrowers. Small and medium enterprises often make up the bulk of borrowers. Preparing packages that suit their needs can help banks grow their customer base. Similarly, insurance companies enjoy economies of scale in offering insurance packages. So it allows them to enhance their products and services to satisfy the needs of a specific category of customers, such as people who are suffering from chronic illnesses or senior citizens. By providing multiple financial services, financial intermediaries can lower the cost of information production for each service by applying one information resource to many different services. For example, an investment bank can evaluate how good a credit risk is when making a loan to the firm. It can also use this information to decide whether it would be easy to sell the bonds of this corporation to the public. Financial institutions may offer their clients a variety of services ranging from investment banking to equities trading that are conducted by the different divisions or business segments. Consequently, as the breadth of a financial institution's duties expands, the risk that the conflict of interest may happen increases. So you can again take that example of investment banks. They may gain economies of scale as well as scope, okay, by providing financial services that tackle the information asymmetry in both primary and secondary markets. They may combine a large variety of activities that include the flotation of new and seasoned equities, advising on mergers and acquisitions, serving as brokers or dealers, provision of research and market making. Conflict of interest, coming to conflict of interest, you can think of it as a type of moral hazard problem that arises when an institution has multiple objectives. Conflict may arise between some of these objectives, which may potentially lead to conceal information or disseminate misleading information. Now, the question is, why should we care about conflicts of interest? This is because conflicts of interest can substantially reduce the quality of information in financial markets. It can increase information asymmetry problems, and this may in turn prevent financial markets from channeling funds into the most productive investment opportunities. And as a whole, this may cause financial markets and the economy to become less efficient. Now, these are just examples of the different types of financial intermediaries. Now, you can just categorize financial intermediaries into few broad categories. For example, here we see three broad categories. The first broad category is depository institutions, which means banks. Then you can have contractual savings institutions. You can have investment intermediaries. Table talks about some of these financial intermediaries. It also discusses the primary liabilities of some of these financial intermediary. That means their sources of funds. It also talks about the uses of those funds. That means their assets. Depository institutions, for simplicity, just refer to them as banks. They are financial intermediaries that accept deposits from individuals and institutions and make loans. So these institutions include commercial banks, the so-called thrift institutions or thrifts, and they can be savings and loans associations, mutual savings banks, credit unions. Commercial banks, we understand that these are financial intermediaries that raise funds primarily by issuing deposits on which checks can be written. Okay, it can be savings deposits which are payable on demand. They can be time deposits which have fixed terms to maturity. So these commercial banks then use these funds to make commercial loans, consumer loans, mortgage loans, and to buy government securities and municipal bonds. So around 5,000 commercial banks are found in US alone. And if you see that as a group, they're the largest financial intermediary and they have the most diversified portfolio or collection of assets. Talking about savings and loan associations and mutual savings banks. So basically, these are depository institutions. Approximately 900 of them are present in the US. They fund primarily through savings deposits, often called shares, and time deposits. Okay, so in the past, these institutions were constrained in their activities and mostly made mortgage loans for residential housing. Over time, however, what has happened is that these restrictions have been loosened so that the distinction between these depository institutions and commercial banks, they have blurred. So these intermediaries, they have become more alike and they are now more competitive with each other. Credit unions are nothing but they are financial institutions. They are approximately 7,000. They are typically very small cooperative lending institutions organized around a particular group. So union members, employees of a particular firm, and so forth. So how they are going to acquire funds is they're going to acquire funds from deposits, which is also called shares, and primarily make consumer loans. Contractual savings institutions, for example, insurance companies, pension funds, they are financial intermediaries that acquire funds at periodic intervals on a contractual basis. So because they can predict with reasonable accuracy how much they will have to pay out in benefits in the coming years, they do not have to worry as much as depository institutions about losing funds quickly. So as a result, the liquidity of assets is not as important a consideration for them as it is for depository institutions. And they tend to invest their funds primarily in long-term securities such as corporate bonds, stocks, mortgages. Life insurance companies, they insure people against financial hazards following a death, and they sell annuities, annual income payments upon retirement. So they acquire funds from the premiums that people pay to keep their policies in force, and they use them mainly to buy corporate bonds and mortgages. So they also purchase stocks, but are restricted in the amount that they can hold. So currently, around they're managing around $6.4 trillion in assets. So they are among the largest of contractual savings institutions. Fire and casualty insurance companies basically insure their policy holders against loss from theft, fire, accidents. So they are very much like life insurance companies receiving funds through premiums for their policies, but they have a greater possibility of loss of funds if major disaster occurs. And for this reason, they use their funds to buy more liquid assets than life insurance companies do. So their largest holding of assets consists of municipal bonds. They also hold corporate bonds and stocks and US government securities. Pension funds, uh, as well as government retirement funds, you can have private pension funds, you can have state and local retirement funds. They provide retirement income in the form of annuities to employees who are covered by a pension plan. Okay, so funds are acquired by contributions from employers and for employees who either have a contribution automatically deducted from their salaries or contribute voluntarily. Okay, largest asset holding of pension funds are corporate bonds and stocks. And this establishment of pension funds have been actively encouraged by the central government or federal government, both through legislation, which requires pension funds, pension plans, and through tax incentives also to encourage contributions. For example, we have new pension scheme for government employees, where the employees they have to contribute approximately 10% of their basic and DA, and approximately 14% would be matched by the employer. Okay, and this has been made mandatory. And of course, there are tax incentives also. Okay, you can claim benefits under Section 80C of the Income Tax Act. Slightly in detail and touching upon some more issues, that is the idea. Okay, for example, if we started with one segment of the financial market, which is bond markets. Okay, so we understand that equity and debt instruments which have maturity more than 1 year, they basically trade in capital market, and those instruments which will have maturities of less than 1 year will trade in money market. This we understand, okay, from our early understanding of the resources that we went through. Okay, water bonds we have already understood. They are basically obligations. They are contractual obligations. Okay, these bonds will be issued by can be issued by corporates as well as government bodies. It could be state government, it could be local government, it could be municipals, it could be federal government or the central government. For example, you can have in India, you can have a Government of India bond. Very recently, if you just Google, you will find that municipal body, I think Indore municipal body also raised some money by issuing bond. So that would be a good example of a municipal bond. Okay, why are these entities raising money? Okay, they are raising money to support long-term operations of the issuer. Okay, and what happens if the terms of the repayment that are mentioned in these contractual obligations, they are not fulfilled by the bond issuer? In that case, the bond holder or the person who buys the bond or the entity who buys the bond, they can just drag this issuer to court. Okay, because this is a contractual obligation, they will sometimes, for example, a good example, recent example is what has happened with Byju's, right? Byju's was not, it failed to fulfill its contractual bond obligations, and therefore these lenders drag Byju's to court, right? So this is a good example. Now, bond markets are markets in which bonds are issued. Okay, you can have a treasury note. Okay, a treasury note or a treasury bond. You can have municipal bond. You can have a corporate bond. If we just look at the amount of these bonds outstanding between 1994 and 2018, just giving a snapshot of what was the picture in 1994, again, what was the picture in 2018. Okay. Just want you to understand what is the composition, how much of the bond is a corporate bond, how much of the issued and outstanding bond is a municipal bond, how much of the issued and outstanding bond is a treasury bond. You will find that as of 2018, out of the 30.4 outstanding bonds, almost 43.8% is corporate bond, 43.5 is the treasury bond, and the balance 12.6% is the municipal bond. Okay, so therefore, largest borrower is corporate, followed by the federal government, followed by municipal bodies. Now we have talked about treasury notes and treasury bonds. They are nothing but instruments which are issued by the US Treasury to finance the national debt and other government expenditures. Okay, so this is one of the reasons why the federal government will borrow in the bond market. They want to finance their expenditure. Okay, they want to finance a national debt. For example, country has taken some debt, it has to pay interest on that. Therefore, government may borrow money to pay the interest on the government borrowings. Okay, if you look at the how much debt US had as of 2000, let's say 2019 June, US was in debt to the tune of $22 trillion. Okay, which means US government had borrowed money by issuing debt securities. Okay, so approximately 62% of that borrowing was by issuing treasury notes and treasury bonds. 26% was government account securities. 10.2% was through treasury borrowings. Okay, again, treasury notes and treasury bonds, they are backed by an understanding, because as an individual or as a corporate entity, if I buy treasury notes or treasury bonds, I have that full faith that the government is not going to default. Okay, full faith on the credit of the federal government, and therefore these instruments, treasury notes, treasury bonds, treasury bills, they are considered to be default free. There is one more reason also why central government cannot default on their sovereign borrowings. The reason is, if when the government wants to repay, they can always print more money, they can always impose higher taxes on the citizens, on the taxpayers, and therefore collect that extra money and then repay its debt. Government can always do that, and therefore these instruments are almost always considered default free, particularly sovereign borrowings, because they are very less risky, and we understand from basic finance theory that risk and return are correlated, so they also are going to pay you relatively low rates of interest. Okay, because they implicitly carry virtually zero default risk. Okay, other typical feature of these instrument, both this treasury notes and treasury bond, is that they are going to pay you interest on a semi-annual basis. Okay. Treasury bills have original maturity of 1 year or less, so this happens to be more like a money market instrument, whereas a treasury note will have an original maturity ranging from 1 year to 10 years, and treasury bonds which have original maturities greater than 10 years. Okay, so like treasury bills, once treasury notes are issued, once treasury bonds are issued, they will have a very active secondary market. Okay, so which means active trading happens for these instruments in the secondary market. And of course, when you trade something in the market, you have to quote a price for these instruments. Okay, and the way prices are quoted for these instruments are that they are quoted in the intervals of 0.125 or 1/8 of 1%. So this happens to be the tick size, the smallest minimum denomination in which the prices can change. Okay, so it can be in the interval of 0.125. So US Treasury will sell Treasury notes, Treasury bonds, and the way it sells is it basically, it conducts on a periodic basis auctions. Now, auctions can be of two types. It can be of a competitive auction. It can be a non-competitive Treasury auction. Okay. So most secondary trading occurs directly through brokers and dealer trades, which means they are OTC, okay, not exchange traded. And the primary market sale for municipal bonds as well as corporate bonds occurs either through a public offering using an investment banking services such as a security underwriter, or through a private placement to a small group of investors, often financial institutions. Municipal bonds, again, you have treasury notes, treasury bills, you have similarly you have municipal bonds. So if the federal government borrows, which means the central government, which means the US Treasury or the government of India borrows, they will borrow through treasury instruments. But what if a municipal body, a state body, a local government body wants to borrow? Okay, so these borrowings will be known as municipal bonds, right? And why these bodies, state bodies, state governments, local governments borrow? They generally are trying to bridge the you can say the imbalance between their expenditures and receipts. Okay, or they are borrowing to finance the long-term capital outlays. Okay, they are these municipal bonds. Buying these municipal bonds is an interesting and attractive proposition to household investors. Why? Because If you buy these bonds, you can claim exemption from your taxes. Okay, whether it's a federal tax or a state or local income tax, you can claim exemption. Okay, again, there is something called something called a general obligation bond. Okay, which are backed by full faith and credit of the issuer, or there's something called a revenue bond as well, which are sold to finance a specific revenue generating project, and they are backed by the cash flows from that project. Secondary market trading for municipal bonds is relatively infrequent. This trading is mainly as a result of lack of information on bond issuers, as well as special features such as covenants that are built into these bonds contracts. Now coming finally to corporate bonds. Now we have left the government bonds. Now we are shifting to corporate bonds, right? Corporate bonds, again, they are long-term obligations issued by corporations, and there is a minimum denomination in which these bonds can be issued. Minimum denomination for this publicly traded corporate bond happens to be $1,000. Okay. Generally, these bonds are going to pay you coupon. So these happens to be coupon-paying bonds. Okay, and these coupons will be paid on a semi-annual basis, just like a treasury bond and treasury note, which also pay coupons on a semi-annual basis. The trading process for these corporate bonds is very simple. Okay, first there will be a primary sale of corporate bond issues that will happen either through a public sale or a private placement. Okay, that we have already discussed. Once you have the public issue done for these corporate bonds, these bonds will be trading in a secondary market. Okay, so there are two secondary markets in the US. Okay, one is if it trades on any exchange, it will be the NYSE. Okay, it will trade on NYSE, and mostly it happens through over the counter. So there will be an OTC market for secondary trading in corporate bonds. So major exchange for corporate bonds is New York Stock Exchange Bonds Trading Platform. That is the name of the trading platform on NYSE. Okay, and you will find that most of the trading on NYSE bond market is completed through their Arena all electronic trading system. Okay, and only a small amount of bond trading volume occurs in organized exchanges. So most trading therefore will happen on OTC platforms through major bond dealers. Coming to bond rating, okay, this is the thing I promised that I'm going to touch upon this, and therefore I want to discuss bond ratings for let's say 5-10 minutes. Let me discuss something about bond ratings now. Right. So, like I was explaining, there are three major global bond rating agencies: Moody's, Standard & Poor's, and Fitch. Okay. So each of these rating bodies, they are going to rank the bonds based on the perceived probability of issuer default, and they are going to assign a rating based on the letter grade. Okay, for example, you'll find that the highest grade quality, which represents the lowest default risk that rating agencies assign, is a AAA. So Moody's will assign AAA. So that's the safest bond that you can buy. Okay. If S&P is assigned, the highest rating will be AAA all cap. Okay, something like this. Okay, similarly, Fitch will also assign AAA, something like this, whereas Moody's will say AAA. Okay, 1A in capital followed by 2A in small. So typically, they will have a hierarchy. Okay, so you will find that bonds which are rated below BAA by Moody's and BBB by S&P and Fitch, they are considered to be speculative grade bonds, and they're often termed junk bonds or high yield bonds. Okay, which means they are more likely to default. The probability that these issuers will default is very high. Therefore, you should not consider buying these bonds. Okay, as a practical matter, if the bond needs to be rated if it is to be issued as investment vehicle by certain institutional investors. So bonds rated BAA or better by Moody's and BBB or better by S&P and Fitch are considered to be investment grade bonds. Financial institutions, example banks, insurance companies, they are generally prohibited by state and federal law from purchasing anything but investments, S&P and Fitch. So as you can see, this S&P and Fitch almost follow the same rating pattern. So therefore, they have the similar rating pattern, but Moody's rating is slightly different. As you can see, the best quality, smallest degree risk is represented by AAA, by S&P. Okay, And then if you go one notch below, AA plus represents high quality, but then it is slightly more long-term risk than top rating. Okay. Similarly, you have triple A and AA minus. This again represent their high quality bonds. Okay. From A plus, this is an upper medium grade. So which means a possible impairment is possible in the future, which means there is a possibility in the future that the issuer may default. Okay. The similar is the case with A-rated bonds or A minus rating bonds with A minus rating. Okay. Slightly below A minus, you have BBB plus, which represents similarly BBB plus, triple B, and triple B minus. All the three represent medium grade bonds. Okay, which means they lack outstanding investment characteristics. The grade is medium, right? And below this, which means BB plus, BB, and BB minus, they represent speculative grade bonds, which means protection is very, very moderate. Okay. And below that, you have B plus, B, and B minus, which are very speculative. They have small assurance of interest and principal payments. So, which means you should not be expecting that the probability that these issuers will pay back your principal amount and interest is very, very low. Okay. And below that, which is triple C rated bonds, they are issuers in a very, very bad condition. They are very, very likely to default. Okay. Similarly, double C, they are speculative in a high degree with market shortcomings. With a single C, they represent the lowest quality bond. So their prospects are poor of attaining real investment standing. And then payment default. If this letter is issued, that means they will definitely default, right? So this is, I hope the question that people were asking about rating agencies, this answers your question. Okay, right. Now coming to who are the people who are going to participate in this market. As we can see, the major issuers of debt market, they are the central government, state government, local governments, municipal bodies, as well as corporates who actually issue bonds. And who are the people? If they are the ones who are selling bonds, then who are the people who are buying bonds? Bond buyers could be households, it could be again businesses, it could be government units, it could be foreign investors as well. FIIs may also buy bonds. Okay. So financial firms, if you just check the statistics, financial firms hold 36.65% of all treasury securities, 51.77% of municipal bonds, and 61.53% of the corporate bonds outstanding. So this is just to give you an idea of who are the buyers, who are the sellers. Let's discuss briefly about some of the international aspects of bond markets. As I have already explained, that international bond markets are those markets that trade bonds that are underwritten by an international syndicate. So they offer bonds to investors in different countries. They issue bonds outside the jurisdiction of any single country, and they offer bonds in unregistered form. So for bond issuers, the existence of sophisticated international bond market increases the available financing options and range of assets. Okay, international bond placements can also increase the risk of an issuer. Okay, now to broadly classify, international bonds can be classified as a euro bond, a foreign bond, or a sovereign bond. Euro bonds are basically long-term bonds that are issued and sold outside the country of the currency in which they are denominated. So, for example, if there is a dollar-denominated bond, they will definitely not be sold in US. So they will be issued in Europe. So they will be called euro bond. Or if a bond is denominated in dollar, it can be sold in Asia, and still it can be called a euro bond. Okay. What about foreign bonds? These are again long-term bonds which are issued by firms and governments outside of the issuer's home country, and they are usually denominated in the currency of the country in which they are issued rather than in their own domestic currency. Okay, so for example, an Indian company raising some funds in Europe. So in that case, even the bond is being issued by Indian company, okay, but the money is being raised in Europe, and therefore that bond will be you can say denominated in euros. So that will be a foreign bond. Good example for foreign bond. Sovereign bonds, we know they are government issued, they are foreign currency denominated. So these are sovereign bonds. Likewise, let's take some time to reflect on stock markets, whatever we have discussed. We have already told you that corporate stock basically serves as a source of financing for firms, which is again different from debt financing or retained earnings financing, which is basically an internal source of finance. Okay. Secondary stock markets are most closely watched and reported of all security markets that we have already seen how movements in the S&P index was reported on the front page of Financial Times, how the movements in the Dow Jones Industrial Average would be reported on the front page of major business dailies. Stockholders basically are the legal owners of the corporation. They have the right to share in the firm's profits, which is paid in the form of dividends. And they are the residual claimants, which means they will be paid only after the payment has been made to, let's say, the bondholders in the form of interest payments. And they are, government is paid taxes, and then what is left will be paid as dividend to shareholders. Okay, they are the residual claimants, therefore they have a residual claim to the firm's assets. They have a limited liability. Okay, and they have voting rights, which means they can choose, they can elect the board of directors. So generally, these voting rights comes with common stock. Okay, so therefore, these common stockholders, they control the firm's activities indirectly by exercising their voting rights in the election of the board of directors. And typical voting rights arrangement is to assign one vote per share of common stock. So this is usually one practice. Okay, you can also have dual class firms where two classes of common stock are outstanding with different voting rights, with different dividend rights for each class. Okay, so two methods of electing a board are generally given as cumulative voting or straight voting. So this is mainly a corporate governance issue. Okay, so with cumulative voting, all directors up for election as nominated by the shareholders and selected by a committee of the board are voted on at the same issue. Number of votes assigned to each shareholder equals the number of shares held multiplied by the number of directors to be elected. With straight voting, the vote on the board of directors occurs one director at a time. So the number of votes eligible for each director is the number of shares outstanding. Primary and secondary market, I have already explained to you. Primary stock markets are markets in which corporations raise funds through new issues of stock. Most primary market transactions go through investment banks. Investment banks conduct a primary sale using either a firm commitment or best efforts underwriting basis. In firm commitment underwriting, investment bank guarantees the corporation a price for the newly issued security. Best efforts underwriting occurs when underwriter does not guarantee a price to the issuer. So a syndicate is a group of investment banks working in concert to sell and distribute a new issue. And the lead banks in the syndicate is the originating house. So this is a good example for primary stock market transactions. As you can see in the graph, most of this primary market transaction goes to an investment bank. It could be a Morgan Stanley, it could be a Bank of America, it could be Merrill Lynch, it could be Nomura, it could be someone else. Okay, so this is an intermediary between issuing corporation and the ultimate investors. Okay. IPO, we already understand, is the first public issue of a financial instrument by the firm. Likewise, you can have a season offering, which is when the company wants to sell additional shares. Okay, although they are listed, but they still want to sell additional shares, then you call this as an FPO or season offering. Okay, preemptive rights gives existing stockholders the ability to maintain their proportional ownership. Okay, registration of a stock can be a lengthy process. So you have to file a red herring prospectus, which is basically a preliminary version of the prospectus that describes a new security issue. Then you have to go for a shelf registration, which allows firms that plan to offer multiple issues of stock over a 2-year period submit one registration statement, which is the master registration statement. So this is how. So this is typically the process of getting shares of stock to the investing public or going public. So this at this point, let's say you decide that you want to come up with an IPO, then you prepare what is called a registration statement and send to the capital market regulator, let's say Securities and Exchange Commission, Securities and Exchange Commission will ask you to file a red herring prospectus, which is going to be advertised publicly on the website and even otherwise. They'll be advertised in, let's say, leading newspapers so that everyone can see. Okay. Then SEC will request changes or additional information. Okay. So this is generally a waiting period when the capital market regulator is evaluating the prospects of the company which decides to go public. Okay. Once the waiting period is over, official prospectus will be issued. Okay. And then a timeline will be fixed that when is the time when shares will be allowed to go public, which means when will the bidding period open. Okay. When actually the investors can bid for the shares. So that bidding will happen through a book building mechanism or some other auction mechanism. And finally, the shares will be allotted and then secondary trading will start happening. Okay.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.
I was talking about the two channels, the direct finance channel and the indirect finance channel. So what happens in the direct finance channel? The borrowers, they actually come and they issue some instruments. For example, I told you there were a few segments of financial markets that this facilitates this transfer of funds. For example, if I just talk about a bond market, what will a bond market, how will direct financing happen in a bond market? A borrower will actually come to the bond market, sell those bonds, meaning issue bonds, okay, which will be, these bonds will be subscribed. This is one way of saying these bonds will be bought by the lenders, who may be individuals, who may be corporates, who may be, God knows, government bodies. And therefore, this channeling of fund happens. Okay, the other channel was the indirect finance channel. Okay, where the channeling of funds happens through some intermediaries. Okay, so I told you the intermediaries could be a bank, could be a mutual fund, could be a NBFC, okay, etc., etc. There could be so many intermediaries that can actually facilitate this flow of fund. And once the intermediary is present to facilitate this flow of funds, it becomes an indirect finance channel. And I showed you a few statistics how indirect finance channel is very, very prominent, at least in some countries. For example, I took the case of Germany. I took the case of, I think, US also, where this indirect finance channel is very, very prominent. Okay. So moving ahead with this discussion, I just want to talk about more about this particular important intermediary, which is called bank. Okay, which occupies a very, very prominent place in most of the financial markets to actually facilitate this indirect financing. Okay, so if you just if I just talk about this important considered financial system, which on the indirect finance channel, we are talking about banks. And banks, basically, as an intermediary, they play a very important role in channeling funds to borrowers with productive investment opportunities. Okay, so I can provide you some important statistics here. For example, you can see here at the amount of, the amount of credit which banks provide in US. Okay, almost like 6 trillion annually. This was, again, the data is a little old. If you just check the latest data, this figure has jumped up to $10 trillion annually. Okay. Now, if you think of the important task in our lives, how banks can help accomplish this, you can understand that banks, they provide loans to businesses. Okay, so they must have taken loans in one or the other form, right? Similarly, if you want to buy a new car, new house, banks will definitely provide loans for that as well. Banks definitely play a very, very important role. Now, what we'll be doing is we'll be examining how and why banks make loans. Okay, how they acquire funds and manage their assets and liabilities, how they earn income. Okay, and our discussion will majorly revolve around commercial banks, right? And we are not talking about investment banks. We're not talking about mostly. Basically, we're focusing mainly on the operations of commercial banks. Okay, and the reason is very simple, because they are the most important intermediary in any financial system. So if you just talk about the bank balance sheet. So first of all, let's understand what is a balance sheet. Okay, and what does bank balance sheet represent? Okay, now what does balance sheet of a commercial bank indicate? Answer is very simple. The balance sheet provides basically a list of sources and uses of bank funds. Okay, sources of funds are shown on the liability side, and some of the common sources of the funds for commercial banks may include, checkable deposits, may include time deposits, may include discount loans from central banks, may include borrowings from other banks and corporations, bank capital, etc., etc. Similarly, how a bank uses its funds is shown on the asset side, and these may include reserves, cash items in process of collection, deposits at other banks, securities, loans, other assets, mostly physical capital. Okay. So as the name implies, both the sources and the uses of funds should balance. Okay. That means total assets should be equal to total liabilities and capital. So just to clarify, banks will obtain funds by borrowing and by issuing other liabilities. Now, banks will use these funds to acquire assets, for example, securities and loans. Okay. Banks make profits by charging an interest rate on loans as well as other securities that they may be holding. They will charge a higher interest rate than the interest rate that they would be incurring on their liabilities. So that means they'll be paying less on the bank deposits. Okay. The other thing which is clearly seen on your slide itself is, as the name itself suggests, bank balance sheet. So the emphasis on the second term, balance. Okay, so there should be a fine balancing between total assets and total liabilities and capital. So this is basically the uses of funds which the bank raises, and this is basically how the bank is raising its capital. Now this is typically how a typical balance sheet of any commercial bank would look like. So we have on the asset side few items, and on the liability side we can see there are few items. For example, on the asset side, if you can just see reserves and cash items, okay, you have securities in the form of US government and agencies securities. Okay, basically banks must have borrowed these instruments. Okay, either US government, let's say treasury bills, treasury bonds. Okay, similarly other instruments which are issued by government backed agencies. Then securities may be in the form of securities issued by state and local government and other securities, for example, municipal bonds, right? Other assets could be your commercial and industrial loans, real estate loans, interbank loans, consumer loans, and of course, miscellaneous loans, okay? And then there could be physical capital, other assets, etc. Okay, so this all comprises the assets of the bank. What about the liabilities? If you just check the liabilities, you have checkable deposits, you have non-transaction deposits, you may have small denomination time deposits, okay, which may have denomination less than $100,000. Plus, you can have savings deposits, okay. Then you can have large denomination time deposits. Then other liabilities. Then there could be few borrowings, and then bank capital. These are basically on the liability side. Okay, so now let's start talking about the liability side. We are talking about the items one by one. So we are starting with checkable deposits. So what are checkable deposits? As you can see, they basically allow your the owner or the depositor to write checks to third parties, which basically, as the name itself implies, there are deposits against which banks would issue checkbooks, and you can actually write checks to operate those accounts. So these are checkable deposits. You can have different flavors or varieties of checkable deposits. For example, you can have non-interest earning checking accounts. Okay, you can have interest earning negotiable order of withdrawal now accounts. Okay, you can have money market deposit accounts. What is now account? Now account, as the name itself suggests, it is a negotiable order of withdrawal account. So this accounts will earn interest. It's an interest-bearing account on which checks may be written. Okay, and if you go back in the history, these type of accounts were actually came into existence, were authorized in 1981. Okay, and these type of accounts, they pay you a relatively small return. Okay, therefore, if you have any balance in the now account, it should be kept at the minimum necessary. Why? Because anyway they are going to provide a minimal interest rate. Okay, so you should keep your balance in the now cost to minimum necessary to provide whatever the funds is required without incurring any service charge. Okay, money market account is again interest bearing account. Okay, these accounts will pay you higher interest than the regular savings account. Again, you will get a checkbook as well as debit card privileges along with this account. So one of the features of checkable deposits and money market accounts is that the bank has to pay depositor if he shows up at the bank. Okay. Similarly, if a person comes with a check, okay, the bank has to pay out funds in cash or credit the amount to the person's account. Okay. So checkable deposit, as you can suggest, it becomes a liability for a bank. Okay. Why? Because the depositor can withdraw the funds and the bank is obligated to pay. So on the other hand, they are also usually the lowest cost source of bank funds. Okay, the bank does not have to, the cost for raising money through this becomes very low for a bank, particularly for large banks. Coming to non-transaction deposit account, so you can think of non-transaction deposit account as any deposit account that is not explicitly considered a transaction account. So in layman terms, you can think of a non-transaction deposit as those deposits that cannot be withdrawn. Okay, neither can it be transferred to third parties using checks or telephonic transfers. Okay, so these non-transaction deposits, they are the primary source of bank funds. So usually these deposit accounts will not come with check facility, which means that owners cannot write checks on non-transaction deposits. So they usually pay higher interest rates than checkable deposits. So non-transaction deposit accounts will include savings accounts as well as time deposits. And of course, you can see if you can just see any other item. For example, if you see here, most of the bank's financial assets, they are funded by borrowings, which are basically debt. Okay, and again, if you just want to classify this, borrowings can be classified into two types. For example, borrowings from the money market and capital market, and borrowings from depositors. So borrowing from depositors anyway is reflecting here. Okay, so banks can also obtain funds by borrowing from Federal Reserve System, Federal Home Loan Banks, other banks, corporations, etc. So commercial banks can go to central banks and ask for loan. Okay, so such type of loans will be known as discount loans or advances. Okay, so if you just go back and check any of the public sector banks in India, also you will find a line item called discount loans or advances. It's very common. Okay, which basically means that, let's say, if it appears in the bank's balance sheet of, let's say, Bank of Baroda, which simply means that Bank of Baroda has approached Reserve Bank of India for some loan. Okay, and that is appearing as a discount loan or advances. So apart from that, banks can borrow reserves overnight in the federal funds market from other banks and financial institutions. Okay, so banks borrow funds overnight to have enough deposits at the Federal Reserve, basically to meet the amount fund required by the Fed. Okay, so banks can also obtain funds from the parent companies or bank holding companies, which will again be reflecting over here. And banks can also enter into repurchase agreements, okay, which means they may enter into loan arrangements with corporations. And finally, they may also raise money through euro-dollar borrowings. Now, this I have already explained. So that non-transaction deposits, basically, if you see, they happen to be the primary source of bank liabilities, approximately 69% in some cases. Okay, and in case of non-transaction deposits, depositors cannot write checks on these types of deposits. Okay, and it incidentally happens to be the highest cost of funding for the bank. Okay, so it, banks have to shell a lot to actually maintain such type of deposits. But again, even though bank it has a higher cost of funding, but they happen to be more stable for banks. It's not as fluid as a savings account. Borrowings I have already explained. Okay, yeah, bank capital. So bank capital, or we can say that it is the net worth of the bank. Okay, so it's the difference between the bank's assets and its liabilities. So bank capital serves two major roles. Number one role is that it primarily acts as a reserve. Okay, reserve against what? Against unexpected losses. And number two, bank capital also protects the creditors in case of liquidation of the bank. So bank's capital is raised by selling new equity or stock or from the retained earnings. So this is how bank's capital is generated. Okay. And in some cases, as you can see, it's clearly written, execution against a drop in the value of the assets, which could force the bank into insolvency. Okay, insolvency being meaning that banks are having liabilities which are in excess of assets. And actually, if the bank is not maintaining sufficient capital, then if a situation like this happens, then it can actually, bank can be forced into liquidation. Okay. Now, what we understand that banks raise funds by issuing liabilities. Next, we will understand how banks will use those funds. Okay, that means we will discuss about asset side of the balance sheet. Okay, so banks are required to park a portion of their fund with the central bank. We know that. All right, these deposits plus the currency that is physically held by banks, they are known as reserves. Now, there are two reasons why banks hold reserves. First, because of the regulatory requirements. Okay, banks have to maintain the required reserves. For example, the reserve requirement may say that for every dollar of checkable deposit at a bank, a certain fraction must be kept as reserves. Okay, for example, if the central bank says that all commercial banks must maintain $20 out of $100 as required reserves, then this fraction 20% becomes a required reserve ratio. Okay, but sometimes bank also hold additional reserves. Okay? So banks actually face this trade-off. On the one side, they have to ensure liquidity. They have to have sufficient cash with them so that if when a customer comes and asks for his money or her money, bank should be in a position to satisfy the customer's liquidity need. Okay, which means bank has to ensure that it has sufficient liquidity with itself, right? On the other side, there is an opportunity cost for holding such reserves. What is the opportunity cost? The opportunity cost is if the bank is holding too much cash, then the thing is bank will not be earning any money on that idle cash. Okay, even if let's say the bank is holding, let's say, some money in very short-term securities, then those short-term securities also will not be yielding banks much. Okay, which means bank is losing on some of its income. So there is an opportunity cost attached with it. So therefore, we can say that banks always face a trade-off. On one side, they have to ensure that they have enough liquidity, and on the other side, they have to make sure that there is an opportunity cost for holding such reserves, and they don't lose so much on that also. Okay, so therefore, banks will have to actively manage the reserves in order to balance their liquidity needs with the opportunity cost of holding reserves. So banks has to do a fine balancing act. Now, let us talk about cash assets of the bank. So we can find this item under the heading cash and balances due from depository institutions. Okay. They are considered to be bank's primary reserves to meet the liquidity requirements. Okay. Now think about which of the assets are very liquid, okay, which the bank can use to meet the liquidity requirements. One is definitely vault cash. Okay. Other is deposits held by depository institutions as well as Federal Reserve banks. So banks use these assets to meet the liquidity requirements. Now these items, where I'm talking about basically cash items in process of collection, they're not immediately available. So banks have to keep converting these items into cash on an ongoing basis in the course of their operations. So what's a good example for this? Let's say State Bank of India, it receives a 1 lakh check written on an account at HDFC Bank. Okay. Although SBI receives this check, it has not received that 1 lakh from HDFC Bank. Okay. So you can see that this 1 lakh would be classified as a cash item in process of collection. And it is an asset for SBI because it is a claim on 1 lakh that will be paid from the HDFC Bank. Okay. Correspondent banking is when smaller banks, they partner with larger banks. So this partnership allows smaller banks to benefit from the network and banking facilities. So this actually helps smaller banks increase the ability to lend money. And in exchange, smaller banks need to hold deposits in larger banks. We have already talked about reserves, cash items in process of collection, deposits at other banks. Okay, so collectively reserves plus cash items in process of collection plus deposits at other banks, they are referred to as cash items in the balance sheet. So whenever you see this cash item in the balance sheet, you immediately understand that it's referring to reserves plus whatever cash the bank is supposed to collect plus deposits at other banks. Okay, so these collectively will be referred to as cash item. and uh, they account for approximately 16% of the assets. Now, securities are basically the second major group of bank assets, and they account for about one-fifth of total assets. Okay, what are the major securities that banks would be holding? Major securities would be securities which are issued by US Treasury and by US government corporations and agencies. You will also find that commercial banks also hold debt securities which are issued by state and local government. Banks are not allowed to hold stocks, so we will majorly find debt securities. They are an important income earning asset for banks and almost provide 10% of revenues. Now, securities issued by US government and US agencies, they would be liquid because they can easily be traded and converted into cash with low transaction costs. And because of their high liquidity, short-term US government securities, they are called secondary reserves. Okay, so they make up about 22% of the assets. Coming to loans, right? And as you can see, loans account for about three-fifths of bank assets, approximately 53% of assets, bank assets. And this makes this most important account category. Okay? So you may have secured loans as well as unsecured loans. Okay? Secured loans are basically loans for which specific property has been pledged as collateral. So in the event the borrower fails to repay the loans, banks will take the assets placed as collateral for the loan. Whereas an unsecured loan represents a general claim against the assets of the borrower. Okay, so banks will usually charge a rate for short-term unsecured loans to their highest quality business customers, and this rate is referred to as prime rate. So in theory, it's the lowest business loan rate which is available at a particular point. Okay, so this is kind of a floor rate. Okay, and borrowers who are less qualified. Okay, so less qualified borrowers will be charged a higher rate than this. For example, bank will say that okay, we are going to charge you prime rate plus 2 percentage points. So the prime rate is let's say 5%. Then the financially weaker business borrowers would be charged 7%, 5% prime plus 2% more, 7%. So loans are typically less liquid than other assets because they cannot be turned into cash until the loan matures. So they happen to be less liquid. And of course, other bank assets represents approximately, you can say 16% of total bank assets. So what are the different items which are which come under this heading? So they include bank premises, fixed assets, assets held in trading accounts, all other assets, including other real estate owned and intangible assets. So all these items will come under this heading. Now, banks perform this transformation of financial assets and liabilities. They convert the short-term funds to meet their long-term needs. So using this process, depositors, they transfer the liquidity risk to banks by short-term funding in the form of deposits. So banks engage in asset transformation. That means they will take small short-term, relatively liquid deposits and transform them into larger, longer maturity loans. And using this process of asset transformation, commercial banks generate net income for themselves. So another way this process of asset transformation is described is to say that the bank borrows short and lends long because it makes long-term loans and funds them by issuing short-dated deposits. So let's take an example to help you better understand what I'm trying to explain to you. Right? We will have to take the help of few accounting entries. So generally, you have to have an understanding of T accounts or the ledger account. Okay. So suppose I give you a hypothetical example that there are two hypothetical banks, which is called First National Bank and Second National Bank. Okay, these are two banks. Okay, and let's say there is a customer, hypothetical customer at First National Bank as well as Second National Bank. Okay, the name is Jane. Okay, so suppose for example, Jane goes to First National Bank and opens a checking account with $100 bill. Right, so the account is opened at First National Bank and Jane becomes a customer there. Okay, so for the bank, which meaning for the First National Bank, it has collected $100 from Jane. So it is a liability because it has clearly, you can see, it has opened a checkable deposit account for Jane and parked that $100 there. So it has become a liability for the First National Bank. Okay, so as you can see in the T account of First National Bank, the liability side goes up by $100 after this transaction. Bank has also collected cash, remember. Okay, bank has also collected cash. So this is just kept in the vault of First National Bank. So vault cash also goes up by $100. Okay. So on the side, asset side, vault cash goes up by $100. On the liability side, checkable deposits goes up by $100. Okay. So you can see I have already told you that cash item in process of collection, vault cash plus borrowings, deposits, other banks, they collectively are called as reserves, right? So as you can see, generally speaking, it's a part of reserve. So I can see the reserves goes up by $100. Okay, vault cash is a part of bank's reserve, so reserve goes up by $100. So we have just rewritten this T account entry using this form. Okay, why? Because vault cash is a part of reserve. So checkable deposit side liability goes up by $100. On the asset side, reserves goes up by $100. Okay, and in general, for any transaction, you will notice that an increase in the bank's reserves will be equal to the increase in the checkable deposits. So there will be a commensurate increase or decrease. Okay, because this is an, you can see it's a double book entry, right? So it has to affect both items on the asset and balance, asset and liability side equally, or actually, no, it will always happen that way. Okay, now let's carry forward our example. Now suppose Jane had opened his account with First National Bank, not by giving cash $100 bill directly to the First National Bank, but by writing a $100 check on an account with that Jane already had with Second National Bank. So what I'm saying is Jane already had an account with Second National Bank. So Second National Bank, she had a checkable deposit account. So they have definitely issued a checkbook to Jane, and Jane had some money in that account. So Jane used that checkbook facility, wrote a check of $100 and just deposited to First National Bank and said, okay, please open an account. I just want to open an account with your bank also. Okay. So in this case, what has happened is the account of the First National Bank will be affected by this transaction in this way. Okay, which means the liability side increases by $100 because it has collected a check, and of course it has uh, opened a new deposit account for Jane. So the liability side goes up by $100 because of that $100 check. Asset side also goes up by $100 because the Second National Bank now owes $100 to First National Bank. So asset side also goes up by $100. So it's more, accurately speaking, this is basically a cash item in process of collection. Okay, but definitely that is a part of reserve. So the asset side, it goes up by $100. So this would appear as cash item in process of collection because the First National Bank will basically now try to collect the $100 from the Second National Bank. Now the First National Bank has two choices. First option is that it can go directly to Second National Bank and ask for $100. This is first option, and this can be costly as well as time consuming, especially if banks are located far apart. Second option is that it can deposit the checks in its account to the central bank, and the central bank collects the funds from the Second National Bank. Now, the federal bank or the central bank will then have to transfer $100 reserves from the Second National Bank to the First National Bank. And of course, after everything has happened, the final balance sheet position of two banks would look something like what is shown here. Okay, so the end conclusion here is that when a check written on an account in one bank is deposited in another bank, the bank which receives the deposit, its reserves will go up by the amount of the check. Okay, whereas the reserves of the other bank will fall by an equal amount. Okay. Therefore, when a bank receives additional deposits, it gains an equal amount of reserves. When it loses deposits, it loses an equal amount of reserves. Now, so far, we were operating in a very, very simple world. We did not bring so many real life complications into picture. So now let's add these real life complications and bring this into our story, right? So now this simple analysis which we have been doing will become a little bit more complicated in the presence of bank regulations. So basically now we are adding bank regulations to our example. Okay. So when we were discussing reserves, so we mentioned that banks, they are obliged to keep a certain fraction of checkable deposits as required reserves. So now, in the earlier case, if you saw that Jane actually opened an account with the First National Bank using a check that it had collected from the second national bank. It just deposited a check, okay, and opened an account with this first national bank. So here, as we can see, the reserves went up by an equal amount, but because I said that this is a very simplistic story, we never brought into the picture the importance of regulations, which says that for every dollar that a bank receives, it has to maintain a required reserve, right? So now we are saying that in the presence of reserve requirement in the real life setting, the banks will definitely would have to create a reserve, which is shown over here, right, on the set side. So let's say I was explaining that, let's say the required reserve ratio is 10%, which simply means that out of $100 of reserves, the banks, the First National Bank would have to maintain $10 as required reserves, which is what is shown over here. And the balance is called excess reserves, which is $90. The balance excess reserve is what the bank can use to do business, which means it can use this $90 to make loans. It can use this $90 to, buy treasury bills, treasury bonds, etc., etc. Okay, it cannot touch this $10. Okay, so now let us talk about what are the different costs associated with maintaining that $100 extra that the bank, First National Bank, has collected from a new customer, Jane. Let's try to see. See, whenever a new deposit account is created, banks will have to maintain some records. Okay, it will have to pay the tellers, which means whoever the clerks or teller people are, basically their employees. Okay, they have to pay some money. They will definitely, the First National Bank will have to incur some cost to clear that check. Okay, there are other miscellaneous costs also. Printer is running, AC is running in the bank, so many things. And of course, the bank needs to pay interest on that $100 deposit that it has, just received from Jane. Okay, whatever the rate is, the bank has to pay some rate. Okay, at that rate, it has to pay that. So the bank will definitely need to recover these costs from somewhere, right? As you can see, out of $100, $10 of deposit must remain with the bank for meeting all those central bank regulations. And bank is free to work with the excess reserves, which was $90. Okay, which means the bank can just loan this $90 to its customers. Banks can just buy, let's say, some securities with this $90. Banks can do anything, okay, to earn money. As you can see, the T account looks like this. Banks need to maintain $10 required reserves to meet the regulatory requirement, and it let's say it gives loans out the remaining $90 to customers. So what has happened is, now on the asset side you have loans of $90 and required reserves of $10, and checkable deposits on the liability side is $100. Okay, so usually these will be long-term loans. Okay, and banks will be charging higher interest rates. As a whole, banks will be making a profit. Okay, now let's understand this through another example. For example, let's say banks charge 10% per annum on the loans provided to customers. Okay, so it has given $90 as a loan on which it is going to charge 10% for 1 year, which means this $90 of loans would fetch the bank how many? $9 of income every year. Okay, and if the bank pays 5% of on its deposits and assume that it incurs $3 per year to service this account, the cost of these deposits would be $8. Okay, so the cost of maintaining that deposit account is $8, and the income that is making from is $9. So therefore, $9 minus $8 would leave $1 per year as profit for the bank. Okay. So in addition, what happens is this $10 reserves would also fetch some interest income, because this is parked in the form of some treasury instrument, so which will also be generating some interest for the banks. Okay. Now let us look at how banks manage to make profits and increase the wealth of their owners. Okay, bank management would also have to consider the interests of depositors and bank regulators. Okay, bank managers, they have a tendency to increase profitability by taking on more risk. Banks also face a trade-off between higher profitability against the desire of depositors to maintain the safety of the deposits. Please understand that banks can fail because of inadequate liquidity or by becoming insolvent. Okay, so banks, as you can see, have four primary concerns which are listed. First is definitely, of course, is liquidity management. By liquidity management, you mean management of banks' liquidity risk. Okay, so liquidity risk is the likelihood that a bank will be unable to meet depositor withdrawal demands and other liabilities whenever that falls due. So bank managers, they need to decide how much liquidity is appropriate for a bank. Okay. Accordingly, they will make assets and liability management decisions. Bank also needs cash assets to meet depositor withdrawal requests when demanded. And because cash assets do not earn any interest for the bank, the moment banks earn more cash assets, it will negatively impact its profitability. On the other hand, banks can earn higher interest on loans and on longer maturity security investments. Okay. But the problem is that these types of assets, they are not easily converted into cash assets. And if they are converted, conversion costs can be quite high. Okay. And therefore, bank managers, they have to ensure that banks take an acceptably low level of risk by acquiring assets that have a low rate of default and by diversifying asset holdings. And this is basically asset management. Okay. Third concern is to acquire funds at low cost. Okay. That means banks also have to manage the liabilities. So that's liability management. And finally, the manager should maintain capital adequacy, which means managers should decide on the amount of capital that banks should maintain and then acquire the needed capital. Okay. Banks also have to manage the interest rate and credit risk. Okay. Credit risk is basically the likelihood that the borrowers do not make interest and principal payments. Okay. Higher interest rates can be charged to riskier borrowers, but such customers also, they are more likely to default on their loans. Okay. Bank managers, therefore, again, they will face a trade-off: the size of the loan portfolio against the amount of credit risk that they are willing to assume. Okay. Interest rate risk is basically the risk associated with changing market interest rates on the value of underlying debt instruments. For example, let's assume that when a bank purchases 100 million of long-term US government bonds, when interest rates are 6%, and if interest rates rises, then the value of bonds held as assets, they will decline. Okay. So if the decline in bond value causes a bank assets to be less than its liability, of course the bank will be insolvent. So these are different concerns. Okay. Now let us see how these assets and liabilities change when depositor withdraws cash from checking account or savings account. So I'm just taking another hypothetical example. Okay. Or let's say, suppose what happens when customers write checks which are submitted to other banks. Okay. So for this example, we are again assuming that banks are required to keep 10% of their deposits as reserve. So reserve requirement is 10%. That means required reserve ratio is 10%. Okay. Now assume that initial balance sheet of First National Bank looks something like this. So on the asset side, you have 20 million reserves, you have 80 million loans, you have 10 million securities. On the liability side, you have 100 million deposits, you have $10 million of bank capital. So this is what it looks like. Okay. So as you can see, because the required reserve ratio is 10%, 10% of 100 million should have been maintained as a required reserve, which means 10 million. But the bank is actually holding 20 million as reserves, which means it has excess reserve of 10 million. So I think you can visualize it very readily. Okay. Now suppose there is a deposit outflow of 10 million. Okay. Because customers withdrew their money from their accounts. So there is a deposit outflow of 10 million. Okay. Which also means that banks loses 10 million of deposits and 10 million of reserves. So starting from 100 million, 10 million has outflown. So deposit now is just 90 million. And on the reserve side also from 20 million, you have just taken up 10 million. So reserves now is 10 million. Okay. So because the required reserve ratio is 10%, it just had to maintain 10% of 90 million. So the bank should have maintained 9 million as reserves to fulfill the regulatory requirement, but in practice, it's actually maintaining 10 million. Okay, which means that bank is still holding 1 million as excess reserve. The important thing that we notice here is that if banks maintain excess reserves, okay, then even if a large deposit outflow happens suddenly, then the bank does not need to change other parts of the balance sheet. Bank does not need to panic, right? It can just service the customer needs. Okay, that means it does not have to touch the loans, it does not have to liquidate the securities. Okay, so no tension at all. Now consider what happens when banks do not maintain excess reserves. Okay, so which means they are operating on a very, very tight, reserves, right? They are not holding any excess reserves, right? Or they are just holding insufficient excess reserves. So in this example, let's start with the case when First National Bank makes additional loans of $10 million so that it holds no excess reserves. So starting position is this, its reserve is just 10 million, loans is 90 million, securities is 10 million. On the liability side, it has deposit of 100 million and bank capital of 10 million. Okay. Now, if you start from here, this is the initial balance sheet. In this scenario, let's consider what happens when the bank suffers a deposit outflow of $10 million. So its balance sheet would now look something like this. Okay. 10 million deducted from here would be 90 million. 10 million deducted from here would be 0 million. So reserve suddenly becomes 0. Okay. And this is a cause of concern for a bank. Right? Why? Because it suddenly finds that it's not able to meet the reserve requirement, because frankly speaking, it should have maintained 10% of 90 million as required reserve, but currently it has just 0. Okay, so suddenly bank manager will come under pressure, right? So bank is clearly in violation of regulatory requirement because it was supposed to hold 9 million as required reserves. So what to do? Okay, at present it has just 0 reserves. So bank clearly has to do something to bring the level of reserves to 9 million. So let's see what are the things that banks can do to eliminate the shortfall. So to eliminate the shortfall, bank has 4 options. First option is that it can just borrow 9 million, which is basically the deficit. Okay, it can either borrow from other banks in the federal funds market, or it can go for corporate borrowing. So one way of doing that is that it can sell, let's say, negotiable certificate of deposits. Okay, balance sheet after borrowing would look like this. Okay, as we can see that extra item indicates borrowing that has appeared on the liability side. So suppose it has borrowed from other banks. So liability goes up by 9 million. Of course, it has used to make the shortfall in the reserves. Reserves level is brought back to 9 million, and now it is clearly fulfilling all the regulatory requirements. So therefore, only for 10% of this has to be maintenance reserve, which clearly it's maintaining. Okay, so no problem here. Okay, so no problem here. Okay, now the thing is, because bank has borrowed from other banks, it has to pay other banks some interest, right? This is how it works, right? It has to pay interest. The other bank will charge some interest to this First National Bank. If the borrowing has been done from other banks, let's say in federal funds market, then there's a rate which is called federal funds rate, which has to be paid out. Okay, and other side reserves, it has gone up by 9 million. Clearly, the things are okay now. This was one way in which bank manager was able to meet the deficit. Okay, other option is, what is other thing that the bank manager can do, or bank can alternatively, what it can do is sell some of the securities to help cover the deposit outflow. So as you can see, initially there were securities to the tune of 10 million. Okay, so bank has liquidated all those investments in securities, and it has used to replenish, not all of them, but at least 9 million of them, to replenish the level of reserves back to 9 million. And so reserves becomes 9 million and securities comes down to 1 million. Okay, this is another option. Okay, another way bank has tried to fulfill the reserve requirement. Okay, liquidate some holdings of securities to cover the deposit outflow. Because it was falling short of just 9 million of reserves, bank just needs to sell 9 million worth of securities and then deposit the proceeds with the central bank. Okay, now after borrowing is completed, the balance sheet, again it looks like this, which is okay. Of course, you will see if the bank does this, okay, if it sells some securities, there are some transaction cost which is involved here. Okay, which means that bank will incur some brokerage, okay, other transaction costs when it sells these securities. Transaction cost would be less if the security is very liquid. For example, US government securities, they're very liquid. Transaction cost would be very less in that case. For other securities, which are relatively less liquid, bank will incur higher transaction costs. So it depends on what kind of securities it is liquidating. Depending on that, it will have to incur some transaction costs as well. Third alternative is that banks can borrow from central banks. Okay, understand that banks has to acquire just 9 million reserves. Okay, it can do that by borrowing 9 million in discount loans from central bank. Okay, it will have to pay an interest rate, which is called the discount rate, to the central bank. And again, the balance sheet would look like this. So here, an additional liability has been generated because it has borrowed some money, 9 million, from the central bank. And on the asset side, it has that borrowed money was used to replenish the reserve level back to 9 million. This is the third option. The fourth option is that banks can reduce its loan by 9 million and deposit that 9 million with the central bank. Okay, and that would bring back its reserves to the desired level. Now it satisfies the reserve requirement, and the balance sheet looks like this. Okay, understand that this is the costliest way of the four options. Okay, banks can reduce its loans. Earlier, its loan was 90 million, which it has brought down to 81 million. So banks can definitely reduce its loans by how it can do by not renewing some of the loans when it falls due. Okay, and this is possible for short-term loans, which gets renewed at fairly short intervals. Banks can reduce their loans by selling them off to other banks also. Okay, again, this can be very costly because other banks do not know how risky these loans are, so they may not be willing to buy the loans at the full value. So there will be some haircut. All right, so of course that will be a loss for First National Bank. So we have just whatever we have discussed. We were discussing how banks are going to hold excess reserves and to actually uh, to counter that trade-off. Okay, so whenever that deposit outflow occurs, we saw that okay how banks through four different routes how they actually try to make up for the reserves. For example, via borrowings from other banks, via selling securities, via borrowing from Fed, via calling out selling flows. But you need to understand that excess reserves. So all in all, you understand one thing. One picture is coming out very, very clearly that excess reserves, they're acting as an insurance, right? Because we saw that in the previous case, we saw that when the bank was having excess reserves, 20 million, 20 million reserves when the bank was holding, then for one 10 million outflow, bank did not bother, right? It was not affected at all. So you can see it was acting as an insurance against the cost associated with deposit outflow. And in the second case, when the bank was holding very tight level of reserves, then you saw that there was cost in the form of transaction costs. There were cost of selling loans in the form of haircuts. There were so many things. Okay, so you can say that excess reserves are a form of insurance against the cost associated with deposit outflows. Okay, and the higher the cost associated with deposit outflow, the more excess reserves banks will want to hold. So in general, you will say that some banks, even though reserve requirement may be 10%, but you will find that they will be holding 18% as reserves. This is one of the reasons. Right. Now let us understand how a bank manages its assets. Okay, how much to give out as loan, how much to buy securities. Okay, so how the bank manages its assets. So banks, just like any other businesses, also wants to make profits. It's a business, right? It's there to make money. So banks would have to understand as a business how to make profits. Okay, so naturally, banks would want to maximize returns that it may generate through loans or through investments in securities. Okay, but it also needs to ensure that risks are under control. It cannot take excessive risks. Why? Because it is dealing with customers' money, right? So banks also they need to make adequate provision for liquidity by holding liquid assets. So banks in general can accomplish all these goals in four basic ways. So banks need to find good quality borrowers who will pay high interest rates and they are unlikely to default in the loans. Bank officers would have to do some screening to remove adverse selection and to weed out borrowers with bad credit profile. So there will be a credit check. Okay. Usually, you will find that banks are very, very conservative in their lending practices. Okay. But the opportunity cost here is that if the banks become too strict in lending, then they may lose out on potential borrowers, okay, who may be willing to pay high interest rates. And second, banks try to maximize profitability. The way they do that is they try to buy securities that promise high returns, but without adding much risk. Okay. So speaking of risk, banks are also diversify their assets to reduce the risk. So normally they would purchase different types of securities of varying maturities. So they would buy short and long US Treasury municipal bonds. Similarly, they would approve different types of loans to many types of customers. Okay, and then of course diversify liquidity management is always there. Liability management I have already spoken. Okay, it's very much similar. They are just managing from what are the sources they are actually, they're basically managing the sources of funds, whether it's coming from deposits or certificate deposits to other debt. Okay, so this has liability management has become very important since 1960s. Okay, so that banks realize the importance of liability management. So they are not relying solely on deposits itself. Okay, when they see loan opportunities, they would want to borrow or issue certificate of deposits as well to acquire funds. And these days they do that, right? You will find that they do that. Just open the balance sheet of any bank and you realize how they are actually managing or running the whole show. Capital adequacy management is basically again another aspect. Okay. So as I've already explained that bank capital, it acts as a cushion against bank failures. Okay. So if we have two banks, let's say a bank which is highly capitalized against a bank which is not well capitalized. If you just look at the highly capitalized bank, it has reserves of 10 million and it has loans of 90 million. And on the liability side, it has deposit of 90 million and bank capital is 10 million. Versus a low capital bank, which has asset side, they have the same profile, but on the liability side, you can see a low capital bank has deposits of 96 million and a bank capital of 4 million. Okay. So what happens now if these banks make loans or invest in securities? Say they make loans, subprime mortgage loans, okay, and they lose money there. What happens in that case? What happens to a well capitalized bank which is highly capitalized? What happens to a low capitalized bank? So you can see, let's assume that after making a loan, subprime loan, they end up losing 5 million from bad loans. Both the banks lose 5 million. Okay. So what is the impact of that 5 million loan loss on a highly capital bank and low capital bank? You can see, so its reserves was 10 million. It has lost 5 million from bad loans. So now loan is just 85 million. Okay. Bank capital was 5 million, deposits was 90 million. For a low capital bank, reserves was 10 million, loans 85 million, deposits is 96 million, bank capital is minus 1 million. Suddenly, you find that its bank capital is completely wiped out. Okay, that's the point that I'm trying to emphasize, that this bank capital, it acts as a cushion against losses. Okay, so just 5 million loss is sufficient to convert this bank, turn this bank insolvent. Okay, now I'm going to touch upon a very, very important aspect, try to understand what interest rates mean and what is the role in valuation, which is very, very important aspect. Why? Because we are dealing with interest rate sensitivities. Okay. And generally, it has been found that many people, they actually have some confusion on what interest rate is, how they actually is, how it affects valuation, etc., etc. So that's I'm going to discuss now. Okay. Again, one thing that we need to understand here is that interest rates are negatively associated with the price of any bond. Okay, which means that if interest rates go up, price of the bond will come down. Why? Because there's a inverse relationship between the two. Okay. Another important point that you need to remember here is that interest rates is not the same as the price of the bond, right? And again, there's a distinction between what is the real interest rate, what is the nominal interest rate. Real interest rates in general, they are adjusted for changes in the price level, whereas nominal interest rates, they are not adjusted for changes in the price level. Okay, so again in this session we're going to highlight some of these issues. So what is the difference and how actually interest rates actually impact valuations, etc., etc. And once we are thorough with these concepts, we are going to understand that okay, we understand how portfolio choice, asset liability management choice in financial institutions, how bank managers make those choices. Again, let's try to understand on a very, very fundamental level, what is present value, right? What is present value? We know what is present value. In general, we understand that different debt instruments will have different cash flows. Okay, for example, you can have a 10-year bond that pays coupons, let's say on a quarterly basis, whereas you can have a 10-year bond which pays coupons on a 6-monthly basis, versus you can have a 10-year bond which pays coupons on an annual basis, right? Different coupons amounts, of course, they will be paying different coupon amounts. All the 3 bonds will be paying different coupon amounts over a 10-year period. One on a quarterly basis, one on a 6-monthly basis, one on an annual basis. As a bond buyer or as an investor, if I have to compare the value of these 3 bonds or the price of these 3 bonds, how would I do that? Okay, I have no tool. I just see that okay, these are 3 different bonds which pay coupons, different coupon in nominal terms at different time points. Okay, so I'll not be suddenly I'll be lost which bond to buy. Okay, I'll be completely lost which bond to buy if I don't have any analytical tool with me to support my decision. So luckily, this concept of present value, it actually what it does is it actually compares the cash flows which occur or which is promised to you at different points of time. It tries to bring all the cash flows at one point of time at T0 to make that comparison very, very easy. Okay. For example, one debt instrument pays you coupons every 6 months until the bond matures. Second debt instrument pays you coupon every 3 months until its maturity. So if in order to compare the value of one kind of debt instrument with other, we need to find what is its present value. Okay. Idea of present value is very, very simple. At a conceptual level, it's simply saying that the money that you have in hand now is more valuable than the money that you collect later on. Okay. And this concept is important because suppose you have $1 today, you can put that $1 in a savings account and it will earn some interest. And 1 year from now, its value will be more than $1. So therefore, $1 today and $1 1 year from now, they will have different values. Okay. And we are going to use this term PV that we see here, PV, to indicate what is the present value of a cash flow or a group of cash flows. Okay, and this is going to make that decision very, very easy. So let's take this example in the context of 4 different types of credit instruments, okay, which actually use this present value concept. One can be a loan, one can be a fixed payment loan, for example, let's say a EMI type loan, okay, home loan, car, vehicle loan, etc., etc., which you need to repay in equal payments, either monthly or yearly. Normally it's monthly, but some cases it can be structured in the form of an annuity. And the third is a coupon bond, and the fourth credit instrument is a discount bond. Okay, so let's take one by one, an example of one by one. If you talk about a loan, okay, this is the simplest of all of the 4 credit instrument. I don't have to spend much time here. Okay, what is loan principal? We know. Okay, it's the amount of funds that a lender provides to borrower. This amount must be repaid to lender at the maturity date. Maturity date becomes the date on which the loan must be repaid. Okay. In fact, the loan term is from the start to the maturity date. Borrower needs to repay the original amount, that means the principal amount, along with some interest. Okay. Therefore, the interest payment becomes the cash amount that the borrower must pay the lender for the use of loan principal. And finally, we also need to understand the concept of simple interest rate. Okay. It's basically the interest payment divided by the loan principal. So in other words, it's basically the percentage of principal that must be paid as interest to the lender. Usual practice is basically to express this interest on an annual basis, irrespective of the loan term. For example, if you made your friend a simple loan of $100 for 1 year, you would require your friend to repay the principal in $100 in 1 year's time, along with an additional payment of, let's say, $10. So in this case of a simple loan, interest payment divided by the amount of loan will straight away give you a measure of interest rate. Okay. So in this example, interest rate would be simply 10%. Now, if you make this $100 loan, you will receive $100 at the end of 1 year because interest rate is 10%. So you can write 100 plus 1 plus 0.1 gives you $110. So if you decide to lend this $110, you will receive $121 at the end of second year. How did we get $121? We got this by basically multiplying $110 with 1 plus 0.1. Alternatively, we would have got the same amount if we would have lent $100 for 2 years. Okay, calculation is just shown to you. So now, coming to the concept of present value. Okay, as you see, if you receive $1 at the end of year 1, what is the present value of that $1 that you receive at the end of year N? Okay, first of all, present value of that future $1 refers to the value at time 0. You need to understand it refers to present value, meaning value at time 0 of $1 that you are going to receive at this point, right? So basically, I'm bringing this $1 value for comparison sake at time 0. So its value that you receive $1 over here, value today will be $1 divided by 1 plus I raised to power n. Okay, this is the thing. So now coming to the simple yield to maturity on a loan. Let's calculate the yield to maturity on a simple loan. Okay, what is the yield to maturity on a simple loan? Yield to maturity, again, it's you can say it's a good measure of investor return on a bond, right? So yield to maturity basically shows what return you will earn if you buy a bond today and hold it until its maturity. So this is what it means, right? So one assumption is that one assumption that YTM makes is that all the coupon cash flows are reinvested at the yield to maturity. Okay. In other words, you can say that yield to maturity is that interest rate that equates the present value of cash flows received from a debt instrument which is valued today. Okay. So using that concept, if I have to calculate yield to maturity for this loan, so $100 is the present value of loan should be equated to $110 by 1 plus I, assuming I is the yield to maturity. Okay. So therefore, yield to maturity calculation becomes very easy. Just readjust these numbers. 110 minus 100 divided by 100. That will give you yield to maturity for this loan as 10%. Okay. So for a simple loan, yield to maturity becomes very easy to calculate. Okay. Now, if the loan is for 1 year duration, present value is $100. Cash flow in 1 year would be $110. You have assumed that yield to maturity is high. You have just readjusted this term, and we have found that yield to maturity is 10%. Therefore, we need to remember the fact that yield to maturity for a simple loan would be nothing but the simple interest rate for the loan. Okay, we can use the term I, we can use the term Y, we can use some other term to actually calculate this. You can just work on this example. What will be the present value of $250 to be paid in 2 years? Okay. So this was the question. I've just taken a snippet and just open an Excel spreadsheet and just try to put there. So generally for these type of questions, first of all, try to understand what is being asked. What is being asked is the present value, which means at time zero. So first of all, you have to draw the timeline. Okay, timeline. So let me draw the timeline. Timeline looks like this. There is year zero. Why year zero is required to be put on the timeline? Because this is the time at which the value has to be calculated, and this is, in fact, will be referred to as present value. Then you have year one, no cash flow. Year two, some cash flow. Okay, cash flow I generally indicate by the term CF. Okay, in short, okay, so the thing is, I needed to calculate the present value of $250 to be paid in 2 years if interest rate is 15%. So this happens to be my discount rate, which I have indicated over here. Okay, so first what I have to do is I have to draw the timeline. Okay, because there's the payment which is expected in year two, so I will draw the timeline starting from 0 till year 2. Okay, I have to indicate cash flow, which I generally say CF. Okay, CF I indicate to represent the cash flow that I'm expecting at each time point. Okay, so CF is $250 at year 2. Okay, DCF is basically discounted cash flow. Okay, which means each cash flow discounted to time 0. So whatever cash flow has been discounted time 0, because the cash flow here was 0, so value came out as 0, right? Likewise, cash flow at year 1 was 0, so discounted cash flow discount, if this cash flow is discounted to time 0, value becomes 0. But we have some non-zero number, non-zero cash flow at year 2. So if you discount this to year 0, it becomes 189.03 or 04 if you just round off 04. So therefore, the present value of $250 to be paid in 2 years becomes $189.04. Okay, same thing. This is the formula. Basically, the same formula that I showed on the slide. In the numerator, you have the cash flow, which is 250. In the denominator, you have 1 plus I raised to power n. Okay, I just linked it. Okay. So this is the thing that I was explaining. Present value that we have already seen. Okay, so first draw the timeline. Pictorially also you can visualize from here that if somebody asks you to calculate the present value of $250, certainly means that $250 will not be paid at time zero. It will be paid at some time in the future. Okay, and it actually mentions that present value of $250 to be paid in 2 years, which means over here. Okay, interest rate is 1.5%, so that we have seen. It simply means you discount that $250 from year 2 to year 0. This is what the arrow is showing. You bring that $250 value to year 0, and the value here will be 189.04. Now let's come to the second type of credit instrument, which is basically a fixed payment loan. Right. Now we understand what is a fixed payment loan, because whenever we take a home loan, whenever we take a vehicle loan, how we actually make the repayment? We make the repayment in the form of equal monthly installments, EMI. Okay, so that is an example of a fixed payment loan. Okay, as the name itself says, that loan principal and the interest, they are repaid in several payments, often monthly, in equal amounts over the loan term. So that is an example of a fixed payment loan. Auto loan, home loan. Okay, so this is an example of fixed payment loan. Okay, so now let's see how to calculate the yield to maturity for such type of loans. So such type of loans will have the same cash flow payments every year throughout the life of the loan. So here also we will follow the same strategy that we followed for the simple loan. Okay, how do you calculate the yield to maturity for such fixed payment loan? So yield to maturity, basically we have to equate today's value of loan with its present value. That's what we have to do, right? So if the borrower, let's say borrower pays $126 every year for 25 years, because that is clearly visible from the cash flow. Okay, 126 is paid at the end of year one, 126 is paid at the end of year two, 126 is paid at the end of year three, and this continues till year 25 when the last payment of 126 is made, right? So if the borrower pays $126 every year for next 25 years, and the present value of the fixed payment loan is $1,000, because this is on the left hand side, we can simply equate this to find the yield to maturity. Okay, so there are two ways you can actually find the yield to maturity. Let's actually I'll show you using method one, which is the traditional way. Okay, so method one. Okay, what does method one say? Let's look at it. So in method one, what you have to do is you have to draw the timeline. Okay, meaning you have to draw the timeline starting from year 0 to year 25 when the last payment is made, and you have to first, let me draw the time, and I have to go till year 25. This is not required, up to this it is required. Okay. In the second column, what I have to do is I have to just indicate what are the cash flow, which are generally indicated by the letter CF. Year 0 there is no cash flow. Starting from year 1, it is cash flow is okay. So we don't actually require year 0, okay, because there's no cash flow here. 126, 126, this will go on, right? This will go on, right, till year 25. This is the cash flow. Then what I have to do is basically indicate what is the discounted cash flow. Okay, now discounting will be done at yield to maturity. So I need that yield to maturity figure. Anyway, I have to calculate this yield to maturity figure. So let's say, because I don't know, I'll have to assume something here. Okay, so let me assume that it is 10%, for example. So this is an assumption. So I'll just write that I have just assumed that it is 10%. Okay, assumption may be correct, maybe not be correct. So I don't know, but this is just an assumption. Okay, so if I just start discounting at 10%, so what is this? This divided by 1 plus 10% raised to power 1. This will go on till this. I have to just drag this. This is okay. I can just drag it. Okay, till year 25. So year 25, I have discounted this, right? So I've got the discounted cash flow. So okay. Now the thing is, conceptually speaking, if yield to maturity was 10%, it was the correct value, then the present value, the sum of the present value should be equal to, as per this equation, it should be equal to $1,000, right? So which means that what is the present value of cash flows? Present value of all the future cash flows. It is nothing but sum of this column, right? Is it equal to 1000? No, right? Which means our assumption is not correct. Therefore, we have to do some trial and error. Okay, we have to change this assumption so that present value comes equal to exactly $1,000. So let's say if I just increase from 10% to 11%, see what happens. Okay, it comes closer to 1000. That's good. That's good news, right? That's good news. If I just increase from 11% to 12%, what happens? It becomes less than 1000, which means the correct yield to maturity is somewhere between 11 and 12%. Okay, so let's say 11.5. So it will give you 1024. So as you can see, it becomes very cumbersome, right? Because it becomes a trial and error method. If I keep going on like this, then it becomes a trial and error method. 11.6, it becomes even closer to 1000. 11.7, it becomes even closer. 11.8, 1000, right? But if I see, is it exactly 1000? No, it's slightly more than 1000. Okay, so but this becomes a trial and error. Okay, so in Excel, this trial and error can be made very easy for you. Okay, instead of you doing this trial and error, let Excel do the trial and error, because in that case Excel will do it very fast. So what you have to do is you have to just go to data, you have to go to what if analysis, you have to go to goal seek, and then what you have to do is goal seek will ask for some commands, right? For example, it will ask you to set cell. So I will say, okay, set this cell equal to how much? 1000, by changing some cell, which is my assumption cell, which is this. I've made an assumption over here, and then I press OK twice. Okay, then it becomes perfectly equal to 1000. See how fast Excel has done it, right? And my true yield to maturity becomes 11.83%. So this is method one. Okay, I've got yield to maturity is 11.83%. Okay, now there is a shortcut also available. So let's see method two. In method two, what I'm going to do is I'm going to use a shortcut. So what to do now? In method two, I'm just deleting it. I'm using a shortcut method, so I'm deleting it. Okay, so method two. So in method two, what you have to do is again draw the timeline, but in this time you have to start from year 0. Instead of year 1, you have to start from year 0 and then go on till year 25. Okay, so I have drawn the timeline. What next? I have to draw the cash flow. So year 0, I have taken a loan. So if year 1 to 25 I'm repaying and I'm indicating with a positive sign, then I have to use another convention. Okay, the cash flow sign will flip. Okay, because one is cash inflow, other is cash outflow. So here I have to indicate with a negative sign, 1000. I am taking a loan of 1000, so it's a negative cash flow. Because the other one is a positive, this has to be negative, right? And then I have to start repaying this loan by 126, 126, 126 every year. This is positive. So this thing is complete. Timeline is complete. So in method 2, I don't have to discount this. Third column is not required in method 2. Okay. Now what to do? I have to use a shortcut, right? What is the shortcut? You see this button FX. Okay, what does this button FX do? If you just press FX, it will open an insert function. So here, what I have to insert is basically type IRR, internal rate of return, and then press go. See, in this function, an IRR function pops up, okay, which is highlighted in blue. So I can double click here itself, or I can just press OK, one and the same thing. So let me press OK over here. What happens? A new dialog box opens up, right? A new dialog box opens up. So it will ask you for the values. Okay, so values are, you have to select everything from year 0 till year 25. I've selected everything. And in guess, what is asking me? Guess value. So guess can be anything. So let me say that guess is 9%. Okay, I have taken a guess of 9%. And then I press OK. Okay. And then So as you can see, using shortcut, I have got this yield to maturity value in just one single line at a click of a button, which is same as what we have got over here. One in the same thing, whether you use method 1 or you use method 2. What method 1 is advisable because you have more control over the process. You see what is happening. In method 2, sometimes you may get you may be tricked, right? So, but it gives you one and the same answer, right? Let us proceed to next example. Now, coming to the slightly different flavor of the same problem, which is suppose you decide to purchase a new house and you need $1,000, or you can say 1 lakh housing loan, home loan. Okay, so you can approach a bank for a loan, and let's say the home loan rate is 7%. Okay, the bank will charge you 7%. Now the question is, how will you find out what is the yearly payment to the bank that you need to pay off the loan in 20 years? Which means I have just reversed the question. Okay, if you have understood the way we have calculated YTM, it will just use this concept of YTM to find out what is the yearly payment or annuity payment to pay off the loan in 20 years. The same thing. See, again, it uses the same concept. What you will have to do is you have to write on everything. You are taking a 1 lakh loan. Okay, and interest rate is basically 7%. Yearly payment or annuity payment, one and the same thing. You have to find out, and this has to be paid in 20 years. Tenure of the loan, 20 years. Okay. Question is, what is my annuity payment? This is the question. What is my annuity payment? Okay. Again, you can work out two ways. Method 1. Let's start with method 1. Which is the long way or traditional way. Here, what you have to do is you have to draw the timeline. Okay, starting from year 1 till the last payment, which is year 20. Okay, and show the cash flows. CF, cash flow. So for cash flow, you need to know annuity payment. So let's make an assumption. So assume that if I have taken 1 lakh loan and I am paying it in 20 installments. So simple, as a simple layman, I would say that, okay, if I pay in 20 equal terms, so somewhere around 5,000, because 1 lakh divided by 20 is 5,000. I know that, right? So let's assume 5,000 then. Okay, this is an assumption. Let's see if I'm right or wrong. 5,000 is my assumption. Okay, so in that case, I'll be paying 5,000 at the end of year 1, 5,000 at the end of year 2, 5,000 at the end of year 3, and likewise, I'll keep on paying this till year 20. And I hope that the loan will be repaid. Okay, but the thing is, we forget that there is a thing called time value of money. Okay, the bank also needs to be paid interest payments. So here, if you just pay the principal amount by just paying this 5,000, the bank just recovers its principal, not the interest. Okay, so what is the DCF? DCF meaning we have to discount this. And I can just drag it to the last value. Okay, and then I have to find what is the present value of all these values. So I have to just take the sum. present value comes out as 52,970. Okay, but the thing is, it should have come out to equal to this, which means this assumption is not correct. Again, you can keep tweaking this. From 5,000, you increase to 6,000. Still not equal to 1,000, 1 lakh. From 6,000, you increase to 7,000. You can keep doing this trial and error. Otherwise, you can quickly go to data, what if analysis, goal seek, and just say that, okay, set this cell, annuity cell, sorry, set this present value cell equal to 1 lakh by changing my assumption cell. Okay, and then press equal twice. Immediately in a fraction of a second, you get the correct answer. That is the present, that annuity payment amount that you have to pay every year to clear off your 1 lakh loan, along with the interest is 9,439. One of you actually told that. Okay. Now, this is method 1. What about method 2? Shortcut. In shortcut, what you have to do is I have to use some inbuilt function, right? Inbuilt function, Excel's inbuilt function. So do you remember any inbuilt function of Excel that does this quickly? I think IRR will give you what? IRR was used to calculate this yield to maturity. Now we have to find this annuity. So I will use PFT, which is over here. Press OK. Now it will ask you so many things. See, the moment I open this dialog box, it will ask you for a rate. What is the rate? First thing it is asking you, what is the rate, which is the interest rate per period for the loan. So I know it is 7%. So I'm just going to link it to this. What is the number of payments for the loan? It is 20 payments. What is the present value of the total amount that a series of future payments is worth now? It is 1 lakh. So I'm going to say minus this. And future value type, I'm just going to just leave as it is and then press OK. And then as in the click of a second, I get the same answer. Annuity payment is basically 9439. Okay, annuity payment is 9439. You can quickly figure out, right? So you have, using method 2 and method 1, you have got the same answer. Okay, this part we have done. So this, see, they have also used the PMT function and they have calculated. Now yield to maturity on bonds. Similar thing we can do for bonds also. So as you can see, similar thing we can do for bonds also, which pays a coupon at the rate of 10%. Okay, you draw the timeline. You say that the value of the bond, see how the value of the bond is calculated. Value of price of the bond is calculated by discounting all the future cash flows, right, at the discount rate, which is whatever the discount rate is, it is yield to maturity. So we'll find the value of the bond. Okay, so you just have to find the I value here. Likewise for consoles, consoles are bonds which pay your fixed coupon payment forever. So there is no life, there is no terminal value, right? So it will keep on paying till the time you hold it, right? It will keep on paying to you that coupon value, see, forever. Yield to maturity on a 1-year discount bond. What is a discount bond? Discount bond is something, it's a bond that is sold for less than its face value. Okay, so the difference between its purchase price, which is P, and it is face value, which is 1,000. It's basically, it represents the interest that is earned. Okay, so we have to understand here that unlike a coupon bond, discount bond does not make any interest payments. It just pays off the face value. Okay, for example, if you have a discount bond with a face value of 1,000, okay, it might be bought for $900. Okay, in 1 year's time, the owner would be repaid this 1,000 back. Okay, so examples of such discount bonds will be basically in US, you have all the treasury bills issued. They are examples of discount bonds. You have savings bonds as well. You have zero coupon bonds, long-term zero coupon bonds as well. So all these are examples of discount bonds. Now the relationship between price and yield to maturity, right? For example, if you just consider a 10% coupon bearing bond. So as example, you see that we are considering a 10% coupon paying bond, which will mature in 10 years time. So it has remaining life of 10 years and the face value of this bond is $1,000. Okay. So first of all, I just want to understand how does the cash flow of this bond will look like? But how would the cash flow be structured for this bond? Question was very simple. How would the cash flow for this bond would look like? So you have to understand what is the face value for bond? It is 1000. So coupon, see, this is coupon in percentage terms, and then you have a coupon in the nominal terms. Percentage terms, it is 10% coupon paying bond. So the question always remains 10% of what? And the answer is very simple, 10% of the face value. So which means if you have to find the coupon in dollar terms, or in the rupee term, or in the nominal term, money terms, then you have to take the percentage and multiply it with the face value. So this becomes a coupon value, right? And it is going to mature in 10 years. Okay. So the question was, how will the cash flow be structured for this bond? So you have to draw a timeline. First, the coupon payment will be made in first year, because this is an annual paying. Assuming this is an annual coupon paying bond, it pays coupon at the end of every year, right? So perfect, right, to this point. And what will be the cash flow looking like? You get this $100 at the end of 1 year, $100 at the end of 2 years, $100 at the end of 3 years, and so on till 10 years. Is the cash flow complete, or is something missing? Principal of the bond is missing, right? Because you have to repay the principal back, right? So when will the repayment of principal happen? In this case, at maturity, which means I have to repay back the principal here, which is basically 1000. So now is it complete? Now it is complete, right? It's complete now. It's complete. No problem here. It's complete. So this is how the cash flows of a bond will be structured, right? Now the thing is, if the second part of the in this slide itself, you saw a table like this. Where in first column, the price of the bond was indicated. Second column, yield to maturity of the bond was indicated for this bond itself, okay, which we have just shown on the timeline. So I will not work out each and every row of this table, but I will just show for the first row. Let's say for the price of the bond is 1200. How do you calculate the yield to maturity for this bond? Okay, how did you arrive at 7.13? Okay, this calculation I will show, and then I'll just move ahead. Okay, so let's say price of the bond is 1200. So I have to write price of the bond, which is 1200. Okay, it's 1200. So how do you calculate the yield to maturity of this bond? YTM. So YTM, we remember we used two formulas, right? One was IRR, one was the traditional method. So let's me use a quicker one, which is IRR. For this IRR, I'll be asked the values. Okay, so I have to draw the timeline again. So I have to insert what was the value at year 0. Remember, this bond price is $1200, which means I have to pay this 1200, which is a cash outflow. Only then I'll start receiving this. Okay, so I am going to IRR, and I'm going to put these values starting from here to the last value. Okay, and then I have to put a guess value. Guess can be anything. Let me guess, take a guess of 10%. Then press OK. Then quickly I have got IRR item of 7.13, which is what is given over here, right? So quickly I have shown you the working for first value. Then you can just figure out for yourself. It's very simple, right? No confusion, I hope. Okay. Forms of business organization, right? So essential question is, first we have to understand what is a business, right? This is one of the topics that we're supposed to cover in this module itself, where we need to understand what are the various forms of business organization. So what is a business and what forms business can take is something we need to have some initial understanding about, right? So business, we understand. Business is any activity which has a motive of making profit. Okay. So any activity with profit motive, you can say it's business on a very, very naive level. Okay. Such activity can be industrial activity. Such activity can be a trading activity. Such activity can be a service activity, for example, banking that we have been discussing. right? Insurance activity, transportation, logistics, anything, okay, it will be called a business, okay. Also, we need to understand that bringing various resources together to set up a business and putting them to work systematically is the job of a business organization, right? Now, once you have a business, once you have the organization, there has to be some owner. Okay, who is the owner? Who owns that business? Who owns that organization? Right. So, next question ultimately is, who is the owner of the business? Owner of the business is a person who takes initiatives to set up a business, provide the necessary funds, bear the risk involved. That person will be called the owner of the business. Okay. When the business, you will find that some businesses are organized on a very small scale. Okay. So when the business is organized on a small scale, it may be owned by one person. Okay. So that one person will provide the funds, he will bear the risk. Okay. But when the same business becomes large, he may need others to join hands. Okay. So the business may be owned by an individual if it is a small scale, or a group of persons if it's a carried out on a larger scale. Okay. So when the business is organized on a small scale, you say you can say it's a sole trader or sole proprietorship, right? When it is owned by a group of persons, it may take the form of partnership firm. Okay. It may take the form for cooperative society. It can be a joint stock company, etc., etc. So it can take different forms when it, when it takes a when it the business starts happening on a larger scale. Okay. So let's try to understand each forms of this organization one by one. What are the characteristics? What are the merits? What are the demerits? Right. So sole proprietorship, which is the rampant form, you will find it everywhere. Sole proprietorship. Okay, the moment you walk out of your house, you will find so many shops, small little shops. Okay, what you say, this grocery shops, mom and pop shops, right? These are all mostly they are sole proprietorships. Okay, some sweet shops. Okay, some tailoring houses. So they mostly these are sole proprietorships, right? So this forms rampant. You don't need to go anywhere. Just go out of your house, you just walk 500 meters in either direction, you will find so many forms of sole proprietorship, right? So in fact, this is the oldest form of organization, and it is also the most common form of organization for small businesses even today, right? Why? Because it is very simple, it is easiest to form. Okay, you just need your capital. Okay, either you have your own place or you rent it, and you have a business model, you run it. Okay, it's as simple. Okay. So what is required is that an individual decides about the type of business to be started and arranges the necessary capital. That's it. Required capital, again, how to arrange for the required capital? Required capital can be mobilized from own savings. Okay, whatever you have your own personal savings, or you can just borrow from friends, relatives, okay, that to arrange that capital. Okay. This business may be carried either in a portion of your own residence or in a rented building. Okay, you can actually, there are people who actually do such kind of business from their own premises, right? The people do it. Okay, or sometimes from most of the times people also do from rented places. Okay, person generally manages the business on his own. Okay, because he's the sole owner, so he has to run the show, right? He also has to take the help of his let's say sometimes he takes help of his family members or employs some persons if necessary. So that also happens. On the advisory front, okay, regarding the management of that sole proprietorship business, so the person can take the advice from others in running the business, but his decision will be the final decision. Okay, so you can say that the sole proprietor or the sole trader enjoys full control over the affairs of the firm. Okay, nobody interferes in his business. He has the full control. Okay, and he also enjoys all the profits earned by the business. Okay, so in case there's a loss, naturally he also has to bear the full brunt of it. Okay, so he enjoys full profit as well as he has to bear all losses all by himself. Okay, so you can define sole proprietorship as one man's business. Okay, in which an individual produces independently with his own capital and skill and intelligence, and he is entitled to receive all the profits and assumes all the risk of the ownership. So now, under this form of business organization, there will be no distinction between the business concern and the proprietor. Likewise, the management also rests with the same person. So this is the sole proprietorship. So what are some of the features? As you can see, whatever we have discussed, we can just list out some of the features of sole trader organization. So for example, I have already explained to you that ownership lies with one person only. So there are no associates or partners. Okay, the person invests his own money or borrows from the friends and relatives. Also, the owner himself manages the business. Therefore, the separation of ownership and management, which is quite common in big businesses, is not present in this form of business organization. Why? Because the proprietor himself manages the business. He exercises the high degree of supervision and control in the working of the business. Also, the thing is that the business does not have any separate entity from the owner. Okay, so the proprietor and the business enterprises are one and the same. Okay, there are no partners, so all the profits will be enjoyed by the sole proprietor himself. All the losses in the business will also be borne by the proprietor himself. Proprietor has unlimited liability, which means that in case of a loss, even the personal property of the owner can be utilized for clearing the business obligations and the debts. Okay. Proprietor, in a sense, has unlimited liability, which means in case of a loss, the personal property of the owner can be utilized for clearing the business obligations or the business debts. Okay, but it has less formality. It has easy to start, right? So to set up a sole proprietorship organization, you don't require any legal formalities. Okay, of course, some restrictions will be there. Legal restrictions will be there for setting up a particular type of business. For example, as an individual, you cannot start a bank or an insurance company. That is not allowed. Okay, you cannot say that. Okay, I'm a sole proprietor. I'm operating a bank of my own. Not allowed. Okay, so legally it's not allowed. Okay, individual cannot start a bank like that. Okay, but one can start a food stall, cycle shop without much legal formalities, right? Even a grocery shop, not much formalities involved. Okay, but of course, some drug stores, some licenses will be required. So there are some variations here. Okay, or even if you are starting a food restaurant, some licenses you will have to procure, right? You need license from municipal corporation. So therefore, the advantages, as we can see, easy formation, no legal formalities to be observed while starting this form of organization. So it's very simple. Okay. Expenditure involved for the formation is also negligible, almost nothing. Okay. So as you know, all profits and gains of the business are solely with one person. Okay. They are exclusively pocketed by the sole proprietorship. So this motivates the proprietor to work hard and develop the business, grow the business to get more and more profits. So his involvement in the business is completely free, right? Again, ease of management. Why? Because the proprietor is the monarch of the business. He owns it, right? He manages the whole business and takes all the decisions himself, right? In other words, proprietor exercises full control over the function and working of the business. Again, you can say that psychological satisfaction is there. Owner does not have to pay separate business income tax. Okay, why? Because that will be taxed as a personal income, right? Other advantages, quick decision. Why? Proprietor does not depend on others for decision making. There are no partners, so he's not required to consult others. There's no obligation, okay, on the part of the owner to consult so many other people. So this enables the proprietor to take quick decision on numerous matters concerning his business. So that becomes easy for him. And of course, there are so many other things. Okay. Of course, there are positives, so there will be negatives as well for this form of business organization. Negatives are that capital and other resources for the individual are always limited. Okay, so sole trader has to rely mainly on his own money and earnings, or he can borrow if necessary from relatives and friends. So the proprietor has a limited capacity to raise funds. Okay, and this actually makes it difficult to plan any large scale expansion. Okay. Second thing is that limited managerial experience. Okay, so in modern business, knowledge and skills in various fields like production, finance, marketing is required in almost all domains. Okay, so it is not possible for a single individual to possess all this expertise in all these areas. Okay, so his decision may not be balanced. Okay, again, this type of business organization is not suitable for large scale operation. Why? Because the resources of the sole trader, they are limited. Okay, so it is suitable only for small business and not for large scale operations. Unlimited liability, as I've already explained, that proprietor has unlimited liability. Okay, so in case a loss happens, then even his personal property and belongings, they can be utilized for clearing business obligations, and therefore he cannot take much risk, and he's discouraged from expansion of the business. Okay, that actually serves as a demotivation. It is also less stable, okay, because the continuity and stability of the business depends solely on one person. Okay, so when that sole proprietor dies, what happens? There's a likelihood that the business will be shut down. Okay, again, you are not applying any checks and controls because sole trader is the monarch of the business. No outsider can question on his actions, on his deals. Okay, therefore, there are no checks and controls on the sole trader. Okay, and the thing is, there is less scope for economies of scale. That is another major disadvantage. Why? Because sole trader usually operates on small scale only. So he can enjoy the benefits of, he cannot enjoy the benefits which he could have otherwise enjoyed if he would have operated on a large scale production for buying or selling. Okay. So this actually raises the cost of business operations. Okay. You can have a glimpse of the proportion of ownerships. In US, for example, almost 71% of all business organizations were sole proprietorships. Okay, 20% were corporations, 7.9% were partnership firms. And if you see what about the net income that they have generated, almost of all the net income generated by all forms of business organizations, 68% was contributed by corporations, 15% by sole proprietorships, and 16% by partnership firms. Okay, in terms of sales, almost 86% of all the sales were made by corporations, 4.7% by sole proprietorships, and 8.8% by partnership firms. So coming to the second form of business organization, which is a partnership firm. Okay, so we understand that the sole trader organization has limited financial resources. Okay, limited managerial ability, limited skills, and unlimited liability. So in case of expansion, more capital and more managerial skills will be required definitely. At the same time, the risk will also increase. So sole proprietor may not be able to fulfill all these requirements. Okay. So person who lacks managerial skills may be having capital. Okay. Another person who is a good manager may not be having sufficient capital. In such a case, in such situation, what can happen is when two or more persons come together, they will pool their capital as well as skills and organize the business. Okay, so a person who doesn't have skills but has capital will pool the capital. The second person who has skills but no capital will pool his skills, and therefore they can jointly come together and start a partnership firm. So this type of organization is called partnership organization, and it grew essentially because of the limitations and failures of the sole proprietorship forms of business. Okay. Now you can define partnerships in so many ways. Okay, in academia, partnership has been defined as a form of business organization in which two or more persons, up to a maximum of 20. Okay, this is a cap. Maximum 20 people can come together, can join hands together to undertake some form of business activity. Okay, even in Indian Partnership Act 1932, it says that partnership is a kind of a relationship between persons who have agreed to share the profits of business carried out by all or any one of them acting for all. Okay, this is how Indian Partnership Act 1932 defines this form of business organization. Okay, now in business organization you have partners. Okay, the person who owns the partnership business individually are called partners, and collectively they are known as a firm or a partnership firm. Okay, so individual members are called partners, and all the members together represent the partnership firm. Okay, and you have to have some agreement. On an agreed basis, partners will contribute to capital, and on the basis of the agreed agreement, they will share the responsibility of running the business. So in some cases, let's say one partner may provide the whole capital or major portion of the capital, let's say 80-90% of the capital, only one partner will provide. Okay, whereas other partners will contribute technical skills, managerial skills, with or without the same capital. Okay, they can also contribute some capital, let's say 10% capital plus all managerial skill. Okay, so all such terms and conditions of partnership, they will mention explicitly in the partnership agreement. So of course, there are features associated with this and also advantages and disadvantages. Feature, as you might have already understood, that to form a partnership, you need at least two persons. Maximum limit on the number of person is 10 for a banking business, 20 for the types of business, which means if you want to set up a bank as a partnership firm, you can. Okay. Maximum number is 10 people should come up. Okay, not more than that to start a bank. Uh, Other thing is it's a contractual agreement between persons called partners. Okay, on the basis of the contract, that contract can be oral also. Just understand it. Contract can be oral. Okay, but in today's term, it's always advisable to have a written contract. Okay, how will the profit be shared? Okay, of course, there has to be an agreement among the partners to share the profits and losses of the business of the partnership firm. Okay, this is one of the basic element of partnership. Okay, if two or more persons jointly own some property, then and shares income, it's not regarded as partnership, right? Coming to the, as you can see, there are merits as well as demerits. What are the merits? As you can see, it's very easy to start, right? Just like trader organization, partnership is also easy to start. Okay? Although it's not as easy as to start a sole proprietorship firm. Okay, but definitely it is much less difficult compared to forming a joint stock company. Okay, here in case of a partnership firm, the partners have to agree to do business together and draw up and sign the partnership agreement. Okay, and after that there are no complex government laws regarding the establishment of the partnership. Of course, more capital will be available. Why? Because in case of a sole proprietorship firm, there was only one person who was bringing the capital. In case of a partnership firm, up to 10 people can come together and pool the capital for a banking firm, or for other types of business, up to 20 people can come together and pool their capital. So, of course, the availability of capital increases, right? Because partnership firm does not always have to rely on single individual for sources of funds. When it comes to the skills and expertise, it also becomes more diverse, right? Disadvantages, definitely there are disadvantages as well, right? For example, unlimited liability of at least one partner, because I have already explained, right? This is one of the most important drawback of partnership firm is that the liability of partners is unlimited, right? And limited capital also, because anyway, even if you are bringing 20 partners or 10 partners in banking firms, still these 10 partners, their capital raising capacity is limited compared to what you can if you just incorporate this as a joint stock company. Okay. Again, you have non-transferability of interest. Okay, you have uncertainty, so much uncertainty. Why? Because suddenly some partner dies. Okay, suddenly some partner becomes insolvent. Then what happens? Okay, how do you resolve the partnership? So there is a discontinuity there. There is a lack of continuity there. Okay, and of course there are chances of conflicts among partners. Okay, so there is scope of misunderstanding and conflicts among partners. So everything is there. So these are kind of demerits. Special forms of partnerships are available. For example, now limited partnerships where liability of the partnership's debt may be restricted to the amount invested in the business. Okay. General partnerships where all partners will be jointly responsible for management and debts. Okay. So there are special types of partnerships also. Okay, and there will be an articles of partnership. Okay, which is kind of a written contract between the partners, which will actually say how the profits will be shared, how the responsibility will be shared, how will you bring new partners in case it is required. Suppose there are 5 people who came together to form a business. Now all 5 of them feel that okay, you need to bring a sixth partner. So there has to be some contract which spells out that okay, in case you want to bring in any new member as a partner, how to proceed with that, right? Or if somebody wants to go out and transfer his share to somebody else, okay? So buying out partner, which is called. So how will that be done? Okay. The next form is basically your company form for organization. So this is very, very common for large scale businesses. Okay, you require large investment, specialized management skills. So you form this form of partnership. Okay. So this is again a separate legal entity apart from its owners, and it also receives the right to exist from the state in which it is incorporated. Okay. It is publicly held, it is closely held. Okay, it may be a domestic corporation, it may be foreign corporation. So this type of company is very, we know it very properly. In case of, for example, in case of if you talk about a joint stock company, that capital is contributed by not one or two persons, but by a number of persons who are called shareholders. Okay, so it's possible to raise large amount of capital. So joint stock company is an association of persons registered under Companies Act for carrying out some business. Okay, so it's called an artificial person, which is created by law with a distinct name, common seal, and perpetual succession of members. Okay, this is very common form of business. Again, people know it, right? So a certificate of incorporation will have all these details. Okay, for example, what is the name of the organization? What is the purpose of this forming this organization? Okay, names and addresses of the incorporators, place of business, capital stock will be authorized. Okay, this how much of that is paid up, how much of that is unpaid. Everything will be name and addresses of offices. Everything will be mentioned in the certificate of incorporation, and this will be filed with registrar, ROC. Advantages of this form of organization is the ease with which they can raise capital. Okay, they can go with IPOs and raise vast amount of capital. Okay, the liability of the owners becomes very limited. Okay, now personal belongings cannot be used to pay the business liabilities. Right, board of directors are there who can hire professional managers to run the show. Okay, and it has unlimited life, which means even if one of the shareholders dies, it doesn't mean the company will cease to exist. It will still be present, right? And it becomes very easy to transfer the ownership of the corporation. You just have to sell the shares to the other person, and it becomes so easy. How easily the ownership can be transferred from one person to another person. You can gift the shares, you can sell the shares, you can transfer the shares, and transfer of ownership happens instantaneously. Disadvantage is double taxation of corporate profits. Corporates will pay taxes on the income that they have generated, and it will actually distribute that after tax income as dividends, and it will again be taxed at the hands of shareholders. So this is kind of a double taxation, which everybody feels, but it's still there. So it's kind of a disadvantage, double taxation, and getting into charter becomes difficult and expensive. So this is one disadvantage. Shareholders or owners have little voice in how the business is run. Why? Because there's a divergence between ownership and management. Okay, managers and owners are not one and the same thing. Unlike a sole proprietor, right, where they were one and the same. Here, there may be two different people, so there may be agency conflicts. All right, there may be agency issues. And of course, these corporations are subject to more government regulations than other forms of business organization. Why? Because suppose this is a listed organization, so you have to actually disclose all your financials on a timely basis. Okay, you have to come up with annual reports. You have to come up with quarterly reports. You have to, even when you are doing something, you have to report to NSC. You have to report to SEBI. Everything you have to be disclosed in advance. Okay, so I just want to conclude this. There's just one thing with respect to portfolio investments. There's something called holding period return. Okay, so when you buy a share or a mutual fund unit, right? You want to calculate what is the holding period return. How do you do that? Basically, check what is the price at which you are selling it, or the ending price. What was the price at which you bought? What is the cash dividend that you have received during the holding period? Divide by your purchase price. That will give you the holding period return, or the rate of return over any given investment period. So that's the holding period. For example, suppose I say that you have bought some share or some investment for $50 at the beginning of the year. Okay, and the value of the investment grows 4%, and you earn a dividend of $3.5. So how do you calculate your holding period return? It becomes very simple. It has grown up by 4%, so 15 to 1.04 is the ending price at the end of the year. You have received a dividend of $3.5. You have add that, right? and you have to subtract the acquisition price, which is 50, and divide by 50. So that gives you a holding period return of 11%. Okay. Likewise, for this holding period return, you purchase a share for $75, you sell it for $27, and you receive $1.25 in dividends. So your holding period returns comes out as 13%. So what this example highlights is holding period return is the sum of dividend yield plus the capital gains yield. That is the holding period return. You can have arithmetic average, you can have geometric average, or you can have dollar weighted average. Arithmetic average is simple. We're just taking a simple arithmetic algebraic average, right? So you just sum the returns in each period and divide by number of periods. Geometric average is basically you have to, instead of summing up, you have to actually use single per period return, and it will give you the same cumulative performance as a sequence of actual returns. So there are ways Excel will do it for you. Okay. And dollar weighted average return is basically an internal rate of return on investment. So IRR I have already discussed. Okay. So suppose you want to measure the performance of your investment in a fund, including the timing of your purchases and redemptions, which return would you calculate? Answer is you should actually go with dollar weighted return. Why? Because dollar weighted return is the internal rate of return on investment, and thus it includes the timing and the magnitude of purchase and redemptions. And therefore, this is the reason for all the mutual funds these days. If you are careful, you will open the mutual fund page, you will see that all of them give you the XIRR, not simple return. Simple return or absolute return they will give you, but most of the time you will find that most mutual funds will give you XIRR. Okay.
Just a quick info, guys. Intellipaat offers an executive postgraduate certification course in investment banking and capital markets by IIM Ranchi. Through this course, you can learn all the important concepts of investment banking and capital markets from esteemed IIM Ranchi faculties and industry experts. With this course, we have already helped thousands of professionals in successful career transition. You can check out their testimonials on our Achievers channel, whose link is given below in the description below. Without a doubt, this course can set your career to new heights, so visit the course page link given below in the description and take a first step towards career growth in the field of investment banking and capital markets.